We'll start off with the Pledge of Allegiance, and I'm going to ask our Honorable Controller to start us with that. Thank you.
Okay, thank you. Good morning, everyone. You'll place your right hand over your heart. Please begin. I pledge allegiance to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all.
Let's see, I think we had a speaker, but the speaker has not signed in.
Correct.
Okay. The chair is running a bit late. I think his airplane has landed. So he's on his way in.
Mr. Runner?
Yes.
That's regrettable. I would like to ask the board's indulgence, if I could, due to my time constraints, if we could go ahead to the H items and take.
Okay. We'll move on to the H items.
I believe the first constitutional function is H7.
H7 is our first constitutional item. I think we have coming up for a report on H7.
So we'll start our meeting with item H7, Special Taxes Matters, Credits, Cancellations, and Refunds. There's only one item.
And who's presenting on H7?
Since it's non-appearance, let me go ahead and make a motion to adopt the staff's recommendation.
Okay.
Second.
All in favor?
Aye.
No objection? Okay.
Okay, now that there's been a vote, I can just say what I had to say, right?
Okay.
I can.
Oh, yes,
now?
this was a, yes.
This is why this appeared.
yes,
Because
please.
I spoke at the time.
Member Harkey, Member Harkey.
Thank you. Thank you very much. This is GFBC Inc., and Green Flash Brewery is a small business leading a budding craft brewery industry in the San Diego beer belt. We have a beer belt. You have a wine belt. We also have kind of a wine belt, Temecula, but we have a beer belt in San Diego with a lot of the craft breweries. They are trailblazers. They found gold in California, and they've experienced California's complex tax laws. Thanks to my partner, the San Diego Regional Chamber of Commerce, the Green Flash case was brought to my office's attention. And they learned basically they had overpaid their taxes but didn't know how to go about getting a refund. They told me their $400,000 plus refund represents to them jobs in the district, economic expansion. And if you saw the Beer Week Festival last week in San Diego, then you know they need capital to buy more products and meet their growing demand. We have a university there. It's a big deal. And for Green Flash Brewery, several universities, for Green Flash Brewery to tap the keg of opportunity, help jobs flow and businesses grow in California, it took my professional staff and the staff of the BOE in general, of the agency that educates the public on proper voluntary compliance, as well as urgency to expedite this important refund and get them back into their business. Thanks to the Board of Equalization Property and Special Taxes folks, sorry, this is early for me, my first talk, working with my staff. Specifically, I want to thank Bill Kimsey, Tracy West, and Shante Gekas. They were able to expedite this refund and continue our education of Green Flash and the industry so they can avoid overpaying their taxes in the future. Imagine that. So thanks to the efforts of the BOE, my professional staff, our professional staff in the building, and everyone else in Special Taxes, thank you very, very much for making this opportunity possible for good tax-paying, business-growing people in San Diego.
Okay. Thank you. Thank you, Member Harkey. That takes us to H8.
Item H8 is Property Tax Matters. There are two items. These may be taken separately or in one vote.
Okay. I'll move to adopt the staff recommendation on both items.
Okay. Is there a second?
Second.
Okay. All in favor?
Aye.
Okay. Without objection. Takes us to H10.
I would like to separate items 1 and 17 for quick discussion,
Okay.
and then move the
1 and 17.
and move the rest of the.
I'm sorry, was that 1 and 17?
1 and 17.
Okay, is that a motion then to
It's a
pick up
motion.
the balance?
Pick up the balance.
I'll
yes.
second that.
Okay, all in favor?
Aye.
Aye.
Okay. Items 1 and 17 were pulled. Member Harkey.
On item 1, I'm not convinced, this is Verizon California, and I'm not convinced that the BCRI methodology is superior to the taxpayer-suggested methodology, and I understand we are cautious because of pending litigation, but I would need a little more detail before I could support the BCRI evaluation. So I am going to recommend a no vote on number 1.
Let me ask, again, maybe from staff, because part of our problem with these issues is that we are required to make a decision today. Do I have that correct?
Yeah, yes, sir.
And the decision is not only a yes or no, but is actually an evaluation?
Yes, the board must set a final value or decide a final value.
So our alternative would be to either accept the value or to replace it with a different value.
Correct.
Okay, let me, I don't know if Member Harkey has an idea in terms of that, or what you're thinking.
Well, I would have had we had more discussion on this, but because of litigation, we can't, and maybe staff would like to comment or not.
Mr. Thompson?
No, the issue here is Verizon, for the first year, proposed a different depreciation method, using a depreciation method that relied on a company that did a study, included obsolescence in its depreciation number, which is contrary to the Board Rule 6, which mandates that any obsolescence adjustment needs to be separately stated from the depreciation. Therefore, staff did not use the method in the original appraisal that was proposed by Verizon. And in the petition that Verizon filed, they really did not do anything with that petition to further define what the issue was. They just stated their opposition to us using the BCRI factors, which is a nationally known used depreciation specialist that publishes depreciation factors not only for the telecom industry but for all industries. We subscribe to that service, and we use it in the preparation of our own depreciation factors for all of our telecom properties. So in staff's opinion, that was more appropriate and better reflected the market for the depreciation of telecom property than Verizon's TFI factors, which were with obsolescence adjustment were proposed for the first time this year. Verizon had opportunity both in the initial production of their appraisal and again on the petition to provide more information to staff, and they did not do that.
Procedurally,
They had their opportunity. The detail was not forthcoming.
okay, and in the sense that the detail was not forthcoming to staff, if indeed they wanted to go ahead and move through a appeal process to the board or in this discussion, and discussions to the board members themselves in regards to this issue, that would have been the typical path, or?
That would have been appropriate had they so chose. They waived not only their oral hearing, but they waived their appeals conference. So we did not engage them on this issue, but that was their choice, not ours.
And the time the time from that would have been from the evaluations that were set back in what, May?
The evaluations were set in May. The petition was filed before July 20th.
So if indeed their process would have been to come and be concerned about the valuation, they would have typically then been able to create a public hearing and an appeal process in the period of time before this.
Correct.
Okay, any other questions or discussion on that? Okay, that was item number 1. Is there a motion?
Move to adopt the staff recommendation.
Second? All in favor?
Aye.
Opposed? Okay. And then 17.
Item 17, I want to move to abate the 10% penalty imposed by the State Assessed Property Division. And it's a failure to file penalty of 10% under Section 830 due to reasonable cause and occurred despite ordinary care and no willful neglect. That's the position. I think that the penalty was assessed for not providing a financial statement required for a complete and accurate property statement. However, SES Americom asserted that they filed the financial statement generated from their company's system that included the required information, and that the format they had provided the information for the past 15 years, but it just wasn't in the desired BOE format. They are agreeing to format information to the appropriate form in the future, but I don't think it warrants a $328,000 penalty. So other than that, I approve staff recommendation, but I just want to eliminate the penalty.
So the motion you would be making would be to
Support staff
recommendation minus the,
penalty of $328,000.
okay.
Waive the penalty.
Before we go there, let me hear from staff. Oh,
Oh, I'm sorry, excuse me.
Go ahead, yes.
The only issue before the board is the penalty, so
Okay.
the value
So the
wasn't disputed.
valuation, I'm not disputing.
Okay.
but I am-
Okay.
So the only issue before us right now is the penalty.
Right, so the motion would be just to abate the penalty.
Okay,
not-
okay.
Could we get a response from staff about
Yes,
the
please.
format of the information provided?
Yes, they, in the last year and this year, they did not provide the income statement information that we require in the property statements. Last year, we informed them that the information they gave us was not appropriate or adequate, and then this year, they filed the same information. And then when they filed the petition, they just gave the same information that they provided in the property statement. So from our perspective, they've ignored our request for the information.
Is there anyone from the company to come and?
These are non-appearance generally.
Right, well, again, they're non-appearance because they chose to be non-appearance.
Right.
Correct.
And I guess this is where I struggle with some of these issues, and that is, I'm as open to anybody to hear from the taxpayer in regards to what their issues are, or feel like where they have been maybe not adequately dealt with. And I'm as available as anybody, I think, in order to do that. So it's frustrating to me, I guess, if, when there's a concern like that, but yet no one picks up the phone and sets up a meeting. And so for that reason, it's hard for me to really get engaged to know exactly what took place, because if they would have contacted me, I would have had a meeting with them, I would have had staff come over, and we would have had a nice long discussion, and I would have tried to understand what the situation was. But short of that, it's hard for me to then be sympathetic to the taxpayer.
Well, probably I should have used my one chance to talk to a board member then, and I did not do it. We did discuss this with the taxpayer, and we felt sympathetic to the argument. I did not, I am very concerned with discussing anything up here with anybody because of what goes on, so I'm just trying to, this is not, it's not a burning issue, but I think $328,000 is a lot of money for a format that we could understand, but just wasn't in the format we wanted. And in fact, they have agreed that they're going to provide that format next year. So I think $328,000 is just a lot of money for a failure to.
Mr. Townsend?
Just a couple of issues. The actual amount in tax is about $3,500. But if they would have given us the information along with their petition that we required, we probably would have recommended an abatement of the penalty. The penalties here are not punitive. They're really just to enforce compliance so we can do our job.
Right, but you just said you would have recommended had.
If they had provided the information that we had asked for, yes.
Yeah.
Okay. I'll finish up this item, turn it back over to the chair. So this takes us to item 17. There was a motion to waive the penalty on item 17. I don't think there was a second.
No
Yeah.
second.
Is there another motion?
Move to adopt the staff recommendation.
Okay,
Second.
second. Without objection? Object?
Thank
Okay. Okay, that takes us through, finishes up, Mr. Chair, item H10. We just did.
Was an objection?
4 ayes, 1.
Okay, I'm sorry. I thought she had saw that. It was, oh, I'm sorry. Did you see the vote?
Yes, I did.
Okay, thank you. Okay, I'll turn it back over to the chair. We're through H10.
We did H7, 8, 9.
I1.
So where are we going?
I1.
I1?
Madam Clerk, on the most recent action, there's a motion and a second with an objection noted. Please call the roll.
Mr. Harton,
Aye.
Ms. Harkey,
This is repeat of the last.
Yeah, thanks.
No.
Mr. Runner,
Aye.
Ms. Ma,
Aye.
Ms. Yee.
Aye.
Motion carries.
Thank you. What's the next item?
Our next item is item I, Tax Program Non-Appearance Matters. I1, Property Taxes Matters.
Move staff recommendation.
Second?
Without objection, members? Such should be the order. Ms. Richmond?
Our next item is I2, Offer and Compromise Recommendations.
Okay. Motion, members.
Move staff recommendation.
Second?
Member Ma moves staff's recommendation, second by Member Yee. Without objection, members?
Never mind.
Objection,
I'll comment later. Can I comment after?
sure. Without objection, members, such should be the order. Member Harkey.
Hi, I just have a bit of an issue for an offer and compromise for a company that doesn't keep books and records and doesn't have bank accounts. I have a real issue with that. I understand that our problem is that we probably can't, in general, enforce anything because we can't prove anything because we have nothing. And I think that that's a problem that we try to avoid with most industries and most businesses, and that we don't accept that lightly. And so I would like to see that there's not some better method for us dealing. I think when a company comes forward and they provide you everything they can, and they still can't meet the muster of burden of proof, that's one thing. But to supply you with absolutely nothing, I don't have a lot of sympathy with that. I think that in those areas, we ought to just stick with what the board says or what the auditor says. I mean, if you can't provide me absolutely anything, then why do I want to believe you over a staff member, or why do I even want to compromise with you? So I think we've got more of these probably coming in the future, and I think we need to find a definite way of dealing with this. So that's all I want to say. Thank you.
Further discussion, members? Direction to staff?
Be working on some policies, maybe.
We would ask that the issue of offering compromise go to the Business Tax Committee for discussion to determine if there is a need for modification, and then bring it back to the process itself, and then bring it back to, relative to the issue we just previously voted on, I see Randy prompting, and then bring it back to the board for further discussion. Ms. Richmond, what's our next matter?
Our next matter is closed session. The members will now go into closed session to discuss settlements and personnel matters.
Thank you, Member Runner.
Thank you.
You asked and we listened. Together, we've designed a California State Board of Equalization website with you in mind. The convenient login button allows you to access many of our online services from anywhere at any time. Drop-down menus make navigation easy. You can do everything from filing a return and making a payment to finding permits and licenses. Our interactive banners highlight the latest news, programs, and services. Popular topics help you find information quickly. The How Do I and Business Center sections offer you even more helpful resources, including individual tax guides for various industries. We also want to hear from you. Tell us, how was your experience? Your feedback is important because it helps us provide you with an improved and more interactive website. So check it out at boe.ca.gov. It's designed with you in mind.
Ms. Richardson, what's our next matter?
Our next matter is item B, corporate franchise and personal income tax matters. Our first item is B1, Craigslist, Inc. Please come forward. Board Proceedings has received contribution disclosure forms for today's hearings from the parties, participants, and agents. All forms were properly completed and signed. All parties, participants, and agents are on the alpha listings provided to your office. Each person sitting at the table will be asked to introduce themselves and, if necessary, their affiliation with the taxpayer for the record. 10 minutes is allocated for the taxpayer's opening presentation, followed by 10 minutes for the Franchise Tax Board or Department's presentation, and 5 minutes is allocated to the taxpayer for rebuttal. Chairman Horton.
I don't think they were working this morning. Oh, yeah? Hello? Oh, mine's working. Do you want this one?
Should I have a green light going here?
Okay, we're good to go.
Mr. Runner? Mr. Runner?
Button to push? Oh, button over there. There we go. Okay, we're good. Thank you. Just don't get a green light.
Okay. Ms. Stovall?
I don't think I have audio yet.
Okay. Quick question, was the discussions earlier this morning on record? Was there audio earlier this morning?
I think so.
Okay. Mr. Thompson, would you please introduce the issues in this case?
Yes, as the board knows, this case involves a determination letter in which FTB allowed appellant to use an alternative apportionment methodology. And the issue is whether, in determining the percentage of appellant's income that would be taxable by California, sales attributable to certain estates in the District of Columbia should be excluded or thrown out of the sales factor calculation.
Thank you. Welcome to the Board of Equalization. You have 10 minutes to make your presentation. Please be advised that we will return and allow you 5 minutes on rebuttal. At your convenience, we'd ask that you introduce yourself for the record.
Thank you. Chairman Horton and members of the board, my name is Bob Mahon of Perkins Coie, counsel for Craigslist. As many of you know, Craigslist is a no-frills website that offers classified advertisement services, and the vast majority of its services are not subject to any charge. One can go on free and post classified ads. However, in 2007, in several markets for job listings, Craigslist did charge, and that's a way of reducing clutter and funding the entity. The markets in Boston and New York, Seattle, Portland, Chicago, and Washington, D.C. All resulted in revenues in excess of $500,000 in the year at issue, 2007. Craigslist's only physical presence has been in California, in Ms. Ma's district, San Francisco, where Craigslist maintains its only office and employs about 45 employees that run the company's operations. As mentioned, in 2010, the Franchise Tax Board issued a determination allowing Craigslist to apportion on the basis of market sourcing of service revenue. So its property and payroll factors were maintained, but the service or receipts portion of the apportionment formula was permitted to be done on a market basis. However, that determination concluded that the throwout rule would be utilized. and the determination specifically referenced Revenue and Tax Code Section 25-122, which is on the board and was distributed as a visual aid to help us focus the discussion. That controlling statute has a disjunctive test. A taxpayer is taxable in another state if either it's subject to a net income tax, or the second part of the test, which is at issue in this case, is that if a state has jurisdiction to subject a taxpayer to a net income tax, regardless of whether, in fact, the state does or does not. The FTB's longstanding rule, as well as this board's precedent, make it clear that this is an alternative test. It also makes it clear that the standard at issue for jurisdiction is the United States Constitution, as well as federal statute. This case is resolved by applying the plain language of 25-122 to undisputed facts. There is no dispute that Craigslist had more than 500,000 receipts in each of the 6 markets. Nowhere in the FTB's 2 lengthy briefs or in any of the administrative proceedings has the FTB denied that California's sister states had jurisdiction to impose a net income tax on Craigslist in 2007 through 2010, the period covered by the determination. The authorities are overwhelmingly clear that California and its sister states could have exercised jurisdiction on the basis of substantial sales prior to 2011, regardless of whether or not they in fact did. First, the Franchise Tax Board concedes that California's economic nexus statute is constitutional. That statute was adopted in 2009, effective in 2011. I want to stress that that statute was adopted a year in advance of the determination at issue. In other words, the legislature adopted economic nexus, deferred implementation until 2011. The determination at issue was issued by the board in 2010. The California legislature understood that it had the power to adopt economic nexus in 2009. It adopted the statute in 2009, delayed effectiveness till 2011, but tellingly, the bill analysis for this was very clear that the purpose of the amendment was to, quote, clarify and specify that companies that operate in the state and make sales are doing business in California and subject to California tax. The delay in implementing economic nexus was a policy decision, not a jurisdictional decision. The FTB does not contend that the legislature was wrong in its authority to adopt economic nexus in 2009. The MTC, of which California was a member and whose charge is to promote uniformity, urged the adoption of economic nexus, and in fact, the statute, very much like the one California adopted, was adopted as a model for the MTC in 2002, years in advance of the years at issue in this appeal, years in advance of California's adoption. California's sister states have adopted economic nexus statutes prior to 2011. The FTB does not contend that those sister states didn't have authority to adopt those statutes prior to 2011. There is no United States Supreme Court authority that suggests that physical presence is required for state income taxes. In fact, the authorities cited by the Franchise Tax Board point the opposite direction. The Quill case specifically concluded that it was deciding physical presence as a requirement of sales and use tax collection only. It, in fact, telegraphed that it wasn't too happy about that decision, but was adhering to it on the basis of stare decisis. The overwhelming majority of states, and we cite in our brief more than a dozen state court decisions in other jurisdictions that have reached the similar conclusion, that is that there is no physical presence requirement for Commerce Clause nexus for state income tax purposes. Craigslist, I want to be clear, is not asking that this board declare any statute unconstitutional. On the contrary, we're asking for the plain meaning of California Revenue and Tax Code Section 25-122 be applied here. Craigslist does not contend that the state of California is taxing statutes are unconstitutional. On the contrary, the Franchise Tax Board's position calls into question and is at odds with the legislature's decision in 2009 to adopt economic nexus. It made a clear policy statement in 2009, a year before the determination, that the Constitution did not require physical presence. I also want to address the board's concern about uniformity. The MTC is the organization charged with one organization charged with advancing uniformity, and they were calling on states to adopt the very statute, the very economic nexus position at issue in this case, in 2002. The adoption of economic nexus does not harm uniformity, it advances uniformity. Indeed, the article on which the board significantly relies, the 1957 William Pierce article, is quite clear that at the outset it should be made clear, I'm quoting from the article, the Uniform Act makes two significant basic assumptions that should not be overlooked. First, it is assumed that the state has jurisdiction to levy the particular tax. In other words, the notion of uniformity is advanced by the assumption of jurisdiction of California and its sister states. Finally, I want to address briefly the state's reliance on Grace and Dresser Industries as a precedent of this board that is suggested should control the outcome of this case. Both those cases were decided in the early 1980s, and they're both due process nexus cases. And in the Quill decision, the U.S. Supreme Court was quite clear the due process clause did not require physical presence. Excuse me, I'll quote from Quill. To the extent that our decisions have indicated that due process clause requires physical presence in a state for the imposition of a duty to collect use tax, we overrule those holdings as superseded by developments in our law of due process. The cases, first of all, Grace, involve a situation where the taxpayer did not have any customers in California. Its presence was transitory rail cars. That case wouldn't be decided any differently today under economic nexus. There were no California sales. There was only transitory presence of property. The Dresser Industries case, which was mentioned in the determination, was a case about the application of 86-272. It wasn't about nexus. Nexus was conceded by both parties, and the sole question was whether the application of Public Law 86-272 was appropriate in the foreign international commerce context. And most importantly, the legislature of California has made a policy decision here. That policy decision was that in 2009, it concluded that it had the authority under the Constitution to impose a net income tax on the basis of economic nexus. All of California's sister states had that same authority, whether they chose to exercise it or not. That ultimately is the question before this board, the plain application of Revenue Code Section 25-122 to undisputed facts. I'm happy to answer questions.
Thank you. Members will now go to the department. The department has 10 minutes to make their presentation. We ask that you commence with your introductions for the record.
Good morning, Chairman Horton, members of the board. My name is Katie Frank, and sitting next to me is Norm Scott. We will be representing the FTB in this matter. Now, currently at issue is whether appellant is considered taxable in certain other states during the 2007 tax year. If appellant is found not taxable in the states at issue, it's required to throw out its sales from its California sales factor denominator. Now, the sole reason why we're here before your board is because appellant asked for an exception from the standard apportionment rules. FTB granted that exception, and now appellant's asking to change the landscape even further by trying to apply a law that didn't become effective until 4 years after the year at issue, and it's trying to apply that law backwards in order to argue that it's taxable in the states at issue, and that's not required to throw out its sales from its California sales factor denominator. Now, appellant petitioned to FTB arguing that the standard apportionment formula did not fairly reflect its business activities. It argued it wanted to be treated similarly to print media. And print media, by regulation, has an alternative apportionment formula. Appellant argued that print media is its competitor and it wanted to level the playing field. FTB reviewed appellant's activities and determined that activities are similar to print media, except appellant operates in electronic form. As a result, FTB granted this new formula, allowing appellant to assign its sales to its customer, similar to print media. And also similar to print media, appellant is required to determine whether it's taxable in other states, and if it's not taxable, it's required to throw out its sales from its California sales factor denominator. Now, the California law in effect during the year at issue, 2007, required a taxpayer to have activities that created a physical presence in the state in order for the state to be able to assert jurisdiction and thus make the taxpayer taxable. 4 years later, California law recognized that a state could assert jurisdiction over a taxpayer that had a purely economic presence in the state. We call this the economic presence or economic nexus standard. Now, when California law recognized this, it did so on a prospective basis alone. Now, here in the 2007 tax year at issue, appellant only has sales activities in the states at issue. As a result, it only has an economic presence, and it's arguing this economic presence is sufficient for the states at issue to assert jurisdiction over it and thus make it taxable. And the crux of the issue in this appeal is whether this economic presence standard can be applied backwards. Now, for the reasons which I'll discuss later, and contrary to appellant's arguments, a physical presence is required during the year at issue. Now, before I go on further, I'd like to give you a little bit of background as to why we're even concerned with whether the taxpayer is taxable in another state and requiring a throw-out if it's not taxable. And it has to do with the apportionment laws, which are collectively referred to as UDIPTA. And a goal of UDIPTA is that if each state were to adopt the same tax scheme, it would result in 100% of income being subject to taxation. And this provides parity with the wholly in-state taxpayer that reports all of its income to the state that it operates in and pays tax on all that income. 100% of income is subject to taxation. And the throw-out rule achieves this purpose by first asking the question, well, is the taxpayer taxable in the other state? And if the answer is no, then the throw-out rule ensures that no income is apportioned to that state to again ensure 100% of income is subject to taxation. Now, the law that governs whether a taxpayer is considered taxable in another state is Revenue and Taxation Code 25-122. And this law has two tests, and either can be met. The first test asks whether the taxpayer has actually been subject to a net income tax or several other enumerated taxes, which are essentially revenue-raising substitutes for net income tax. Here, all the states at issue had a net income tax or a revenue-raising substitute, none of which appellant paid. Rather, appellant's arguing it's taxable under the second test. And under the second test, we don't actually require the state to actually subject the taxpayer to a net income tax. Rather, we deem the taxpayer taxable if that state has jurisdiction to subject the taxpayer to a net income tax. And the purpose of this test is the drafters of UDIPTA, the apportionment laws, recognize that some states might opt to have no form of corporate tax. So, for example, today we have Nevada. It doesn't have a corporate net income tax or a revenue-raising substitute. And it may do this for many reasons, maybe for tax incentive reasons. And the drafters of UDIPTA didn't want to compel these states to adopt a net income tax. So we recognize these states, but only upon meeting the second test. So we ask, hypothetically speaking, if these states had a net income tax, could they assert jurisdiction under U.S. constitutional principles and subject the taxpayer to that net income tax? If the answer is yes, then we deem the taxpayer taxable. Now here, appellant argues that all the states at issue had jurisdiction over its purely economic presence under U.S. constitutional standards, and all these states merely opted not to exercise that jurisdiction. Now, despite appellant's arguments that economic presence is sufficient to make it taxable during the year at issue, there's four main reasons why a physical presence is required. First, there's absolutely no California legal authority that has recognized that a state could assert jurisdiction under U.S. constitutional principles based on economic presence alone for years prior to 2011, so including the year at issue. Instead, we have authority requiring a physical presence, and this can be seen by California case law. Now, California case law interprets its tax and jurisdictional statutes to the extent of the Constitution. So whatever a jurisdictional statute has been interpreted to allow is essentially been interpreted to be limited by the Constitution. They are coextensive. And your board, in Appeal of Grace, interpreted California's jurisdictional statute, which allows the state to assert a net income tax, and found it was limited by U.S. constitutional principles, and that required a physical presence. Specifically, your board said that it declined to follow the lead of another court by accepting mere economic presence, and instead required a substantial connection within, which included a physical presence within the state. So while there's no California authority recognizing economic presence prior to 2011, there's clear authority requiring a physical presence. Second, the terms of the determination letter, which granted appellant this alternative apportionment formula, are also consistent with this physical presence requirement. Now, the determination letter directs appellant to determine taxability based on Revenue and Taxation Code 25-122. And 25-122 directs appellant to use U.S. constitutional standards to determine taxability. Then the determination letter provides further guidance as to what interpretation of U.S. constitutional standards to use. It specifically directs appellant to use the existing California interpretation in effect during the year at issue. It says, based on appeal of Dresser, U.S. constitutional standards will be used to determine jurisdiction. Appeal of Dresser applied a physical presence standard. As a result, it's clear the determination letter is consistent with the physical presence standard in effect during the year at issue. And this is another reason why physical presence is required of appellant. Now, third, apportioning principles also compel application of this physical presence principle. Long-standing apportionment principles require the same standard to determine taxability in California be applied under the second test under 25-122. Now, the standard to determine taxability in California is governed by Revenue and Taxation Code 23-101. And this governs the taxability of what we call inbound sales, because they are sales coming into California. In turn, 25-122 governs the taxability of what we call outbound sales. Those are sales that originate in California and go out to another state. And your board, in Appeal of Huffey, said the standard to determine taxability for inbound sales must be the same standard for outbound sales under the second test. Now, physical presence is a standard during the year at issue for inbound sales, so it likewise must be the standard for outbound sales. This is another reason why physical presence is required. Now, fourth, reliance interests also compel application of this physical presence standard. Now, the only way your board can rule for the taxpayer is by holding that economic presence is sufficient prior to 2011. This will create an entirely new rule, as there's no California legal authority holding this as permissible. And it will cut both ways. It will apply to outbound purposes, so the sales issue, and it will apply to inbound purposes, so California nexus purposes. And this will come as a surprise to many entities that filed no returns in California prior to 2011 due to believing they had no filing requirement due to lacking physical presence. And this will create a great amount of uncertainty. Now, due to these reliance interests alone, FTB is recommending your board continue to apply the physical presence standard for years prior to 2011, and based on this, find that appellant is not taxable in the states at issue and is thus required to throw out its sales from its California sales factor denominator. Thank you.
On rebuttal, please.
Sure. Briefly, first, I want to respond to the reliance interest issue. The 2009 legislation that resulted in the adoption of economic nexus in California was clearly a legislative policy decision that first recognized the constitutional power of the legislature to adopt economic nexus, which it did in 2009. It also made a legislative decision to defer the implementation until 2011. That is a policy decision that California, like its sister states, had the constitutional power to make. But it clearly is also a legislative recognition that there is a disconnect between the constitutional jurisdiction to tax, which existed in 2009, it existed in 2007, and the decision to actually implement it. The FTB will not, under the legislative guidance that the legislature adopted in 2009, will not have the power to retroactively go back and tax out-of-state companies. It is clear that the legislature made a policy decision that physical presence, or that economic presence, is going to apply for 2011 onward. That's different than its separate decision to maintain the existence of 25-122, which speaks to its sister states' jurisdiction to impose a net income tax in terms of applying the throw-out or throw-back rule in this case, or throw-out rule in this case, throw-back rule in other cases. In those circumstances, the Franchise Tax Board does not dispute that Washington had the authority to impose its business and occupation tax on Craigslist. It in fact did in 2010, before California's effective date. That's not disputed by the Franchise Tax Board. It's also not disputed that Washington could have done it earlier. Washington case law permitted the state to impose its business and occupation tax on economic activity alone as early as 2001. It's the legislature of Washington that made the decision not to impose tax. That jurisdiction has been there, as the California legislature, in fact, has recognized. The Grace and Dresser decisions are both due process nexus cases. They neither of which squarely addresses the physical presence issue. The Grace case, again, was a due process case that rejected an Oregon due process case, and the United States Supreme Court in Quill overruled its prior authority on due process. Those cases are at best interesting background, but California made a legislative decision that those cases were not binding in 2009. Those cases weren't binding in 2007 either. And keep in mind, this determination letter was issued in 2010. That was after California's legislative decision to adopt economic nexus. For those reasons, we think it's entirely appropriate, both under 25-122 and the Franchise Tax Board's determination letter, to permit Craigslist to apportion on a market basis using the constitutional standard for nexus. Thank you.
Thank you very much. Discussion, members. Member Harkey.
I'll start and may come back. This is for the taxpayer. So what you were saying is the reason that the 2009 legislation specified 2011 is because the legislature did not want retroactive assessment of out of state.
I'd say that's the effect. The legislative decision-making, is something it's not clear to me. What is clear in the bill analysis is the legislature was recognizing that it had the constitutional power to extend the income tax over economic activity. It's also quite clear they picked a starting point for which to exercise that jurisdiction, which was January 1, 2011. That was a legislative decision, but the legislative process clearly indicates a recognition that it had the constitutional authority to make that call at 2009 and previously. And I don't think there's any doubt that the Franchise Tax Board will be back before this board or courts arguing that it's quite clear that they have constitutional authority to impose an income tax on the basis of economic nexus.
Okay. The apportionment principles that the FTB discussed, the Revenue and Taxation Code 23101 for inbound versus 25122 for outbound, how do you respond to their argument?
Their argument is really a complaint about federalism. It's each state making its different sovereign decisions on how to tax. And let's take two examples, Washington and Oregon. So Washington has no income tax. It's made the sovereign decision not to impose an income tax. It instead imposes a gross receipts tax, much like San Francisco's or Los Angeles's, but on a statewide basis. It has chosen to adopt a physical presence standard for periods prior to 2010. That was, again, a legislative choice. It's not a matter of lack of uniformity. It's that Washington is making a conscious legislative decision that they don't want to tax certain activity. That's their right as a sovereign. Oregon, a second example of a market state issue here. They've long before, in fact, the Franchise Tax Board notes that an early case in Oregon is the foundation in many ways of the economic nexus theory, even for due process. And Oregon has had economic nexus for some time. They don't have a quantitative statutory regime like California and Washington now do. Instead, it's a substantial economic presence concept, which is sort of an amorphous thing. It's difficult to apply. So that was in play for all the years at issue. What's different is that Oregon made a separate statutory legislative sovereign decision to have a different apportionment system that results in Craigslist having no Oregon source income. In other words, it's subject to the jurisdiction of Oregon, and Oregon clearly was exercising jurisdiction on an economic basis. But when you go through the calculations, it produces zero taxable income in Oregon by virtue of Oregon's apportionment formula, which again is its sovereign right. So what the FTB is complaining about is not the lack of uniformity, it's that other states are exercising their sovereign rights differently than California. And of course, that's a problem that's been inherent in the federal system since its foundation. And it's one that organizations like the MTC and UDIPTA are aimed at trying to reduce. But each of these sister states had jurisdiction. Some of them were exercising it, some of them weren't. And again, the statute, the California legislature adopted for taxability, not only contemplates it, it's there because states have that right to exercise its jurisdiction differently than California.
Thank you. Okay, FTB, as I understand it, your case is that you had negotiated earlier on an earlier tax situation and allowed a certain procedure, but part of your negotiations were that you would be able to exercise the throw-out rule.
Right.
Okay, then the legislature acted in 2009, and so what you're saying is that in 2000, if that had been in place in 2007, you wouldn't have had the throw-out rule, but it wasn't in place in 2007, and so you're believing that the taxpayer wants a retroactive treatment.
Right, so not necessarily a throw-out rule, but this economic presence rule, they're asking for a retroactive.
Right, the throw-out would have been there anyway.
Yes.
Right, so it's a nexus issue.
Yes,
Right.
yeah. And so I was hoping I could respond to a couple of things that he had mentioned in regards to Grace being a due process case. And actually, when Grace was rendered, at that time, due process clause analysis and commerce clause analysis, those are the two clauses under the Constitution that state taxes are limited by. Those are really one and the same. So it's really not, I think, accurate to say that this Grace doesn't apply because it's purely a due process clause case, because at that time, due process clause and commerce clause analysis, again, they were just essentially one test. Anyways, I wanted to respond to that comment there. And then another thing, sorry.
Go on.
He had mentioned about how we were not respecting other states. And if taxpayer, we do respect other states. And again, taxpayer can be found taxable under either section under 25-122. If taxpayer actually filed in taxes in another state, filed a return, if that state had economic presence standard, even though it's not our rule in 2007, we would have recognized that if the taxpayer actually filed and paid taxes there. But they didn't. Rather, they're asking under the second test. And really, based on apportioning principles, the only way for this portioning, the second test to work properly is you have to apply the same standard for taxability for inbound and outbound. And that was as stated by your board in Appeal Puffy.
Okay, I understand that. That's your contention. So, Representative, for the taxpayer, what do you say about applying the same test inbound and outbound?
I think there is a fundamental distinction between Huffy and similar cases in this case, and that's because the legislature recognized that there was a distinction between the two tests. The legislature in 2009, which again, I want to make sure we're clear on the timing, the determination of the FTB happened in 2010. So it's after the legislature has adopted an economic nexus statute, after it has made a legislative decision that it had constitutional authority. At that point, the California legislature has made a decision that it has jurisdiction that it's not going to exercise. It is inappropriate for, and in fact, the Franchise Tax Board doesn't suggest that California's decision has any impact on its sister state's authority under the second prong of 25-122 to exercise jurisdiction over Craigslist. And as to the complaint that Craigslist didn't pay tax, well, a taxpayer isn't obliged to pay tax that isn't due. Washington made a decision that it was not going to impose physical presence. We had no taxable income in Oregon or Washington. We have no return to file. That's because Oregon and Washington aren't exercising jurisdiction. It's not because they couldn't. In fact, it's quite clear they could, and both of them have, or at least Washington has, I should say.
Okay, for the Franchise Tax Board, do you agree that in 2007, states at issue had jurisdiction under the U.S. Constitution to impose a net income tax on Craigslist?
We have no authority in California recognizing that. Rather, the authority we have, which we're bound to follow, Appeal of Grace, says that a physical presence is required.
But, Member Harkey, I think it is fair to say that we acknowledge that some decisions of other states did exercise jurisdiction on the basis of economic presence. But the distinction that we'd like to draw in response to your question is that recognition had not taken place in California law as of 2007, and I think that's where the real crux of the issue before the board is.
Isn't it just because there were no cases in California, but there were other cases that had been settled across the nation? Is that not true?
Well, every authority in California up until the legislature took action on revising Section 23101 said the constitutional standard as we apply it in California is physical presence. And so it was really settled law. We didn't see many cases on it because it was settled law and taxpayers filed or didn't file their returns based upon that interpretation. So when the legislature took action here and made its decision to essentially change the constitutional standard that California would apply in interpreting its laws, it did so effective in 2011 and said, we think the legislative intent was clear that the intent was not to disturb the law before that time. And Craigslist has made a couple of comments about the legislature made a policy determination, and I think we do agree with that, but I think we would respond by saying that we're here before the board today because we believe that Franchise Tax Board and this board should respect that policy determination to apply only the economic presence standard in the timeframes prescribed by the legislature.
Well, as I read the legislative analysis, I felt, or I read it as though they had always kind of recognized economic presence and they just merely wanted to establish a bright line on this. And so what your interpretation is different?
Right, so yeah, the appellant had made the argument that the legislative history said it was clarifying existing law. So I have a couple of points in regards to that. One, I think if you look at the statute and then the legislative history as a whole, that doesn't seem to be the case. One, because the statute applied the change on a prospective basis. If it was the existing standard, there would be no need to apply it in a prospective manner. Also, if you read the legislative history, you'll see that there are several instances in which the legislature says that it's clarifying something. It says it's clarifying gross receipts and also clarifying the treatment of unitary groups. And there's also another instance of it. Now, the treatment of unitary groups and the treatment of the gross receipts term, those were clear changes in law. In regards to the gross receipts issue, that said that certain treasury receipts are no longer considered gross receipts. And then in regards to the treatment of unitary groups, after 2011, we used the Finnegan standard, whereas before we used the Joyce standard. So you see in the legislative history, it actually says there, similarly says that it's clarifying certain terms that were clear changes. So what it appears as if the legislature was saying is we're clarifying what this amendment is supposed to do. And then also, case law has discussed other cases where the legislature has said we're clarifying existing law. And case law has said, okay, when you look at that language in legislative history, you have to look at it in context and obviously make sure that it doesn't result in absurd results. And if a law is truly clarifying existing law, then it will be clarifying the law as it was the day that it was put into existence. So here, the law in question is Revenue and Taxation Code 23101. That's California's jurisdictional statute. It was first put in existence in 1951, and I don't think anybody would say that economic presence was sufficient in 1951. Again, in order to have jurisdiction, you need to have substantial contacts. And in order for a taxpayer to have substantial contacts, that taxpayer would have to be physically present in the state in 1951. There's no way the taxpayer could meet that standard. Whereas, 2011, obviously the structure of the economy has changed. Now we have internet, we have all these other technological advances. So now it's permissible, but if we read this to say it was clarifying existing law all the way back to 1951, that would actually, that just would lead to an off result. So I think taking into consideration the language of the statute, the legislative history, and then also how case law says we should interpret this, I think all points to the direction of that this is not a clarification of existing law.
Well, 1951, there wasn't any of this, so we know that, I guess that argument doesn't carry as much weight with me as where we were in 2007 and the reason for the change in 2009. So there was a case, I believe it was an opinion written by the California Court of Appeal, the 4th District, and Harley-Davidson. And I'll just read a quote from that. It says, "Indeed, the majority of state courts have considered the issue, have concluded that economic presence is sufficient to satisfy the Commerce Clause for taxes other than sales and use taxes." Doesn't that kind of apply here? And this is just a recent decision.
Right, well, and Harley-Davidson actually found a nexus in California on a physical presence argument. It was an agency nexus issue. So while they might have acknowledged that other states have gone in that direction, and we don't dispute that, they have, that court said, no, we're still going to apply the physical presence standard.
Well, my biggest issue here is that there's a constitutional issue. There's recent legislation. The legislation clarifying is the term that's used. That's to clarify existing law. And I think that was almost a nod to the constitutionality of it. I do understand the 2011, but I thought that you had said that, or somebody said, that the 2011, the prospective move was to preserve Revenue and Tax Code 23101 on the inbound so that there wouldn't be penalties for inbound revenues. Is that not what I heard here? So, we're kind of, anyway, this is a very interesting case. And
we think so too.
I got into the weeds really deep, and I wish I were an attorney to argue it. But I think it's a pretty simple, straightforward case when you start breaking it down. The state has a jurisdiction to impose an income tax. The taxpayer should be considered as taxable whether or not the state is actually taxed. And the legislature concurred with that in 2009. Established the economic presence, established a bright line of $500,000 or and then also wanted to prevent regressive inbound issues. So I'll just leave this. I'm through now. Thank you.
Member Ma.
It is an interesting case. I believe I was on the Revenue and Taxation Committee in 2009, and many of these bills came up because of the Great Recession, 2008. The Amazon tax was floating around, whether internet sales was or wasn't going to be taxable, trying to figure out nexus to California. And I recall when we passed these bills, whether they're clarifying or not, setting that date as the start date was really kind of an indication to taxpayers that, normally we pass a bill in 2009 and we say it's going to be effective January 1st of the following year, which is the normal course of bills. And the fact that we said it's going to start effective 2011 was really to give the taxpayers some time to adjust their accounting, systems, the way they are recording and reporting, and to allow them the opportunity to, report differently so that when the effective start date starts, that they have adequate time to prepare and adjust. And so we did that a lot in the Revenue and Taxation Committee is, give them 2 years, give them 3 years, give them 4 years sometimes, just because corporations, are doing business in many states and they have computer systems that they have to adjust to accommodate the new laws that we establish. I also believe that establishing that $500,000 limit was not a clarifying statute, but it was an indication that this is the number that California felt we wanted to use, and every other state was using different numbers to determine nexus, but we felt $500,000 was the correct nexus. I understand that, clarifying, may have been used in the language. I really feel that when we pass laws in the legislature on a certain date and create effective dates to move forward, that's where we want all of the tax agencies to adhere to, is that effective start date. In this case, I feel that they, Franchise Tax Board allowed Craigslist to use this alternative method for that particular year. And even though the legislature passed a law in 2009, it wasn't effective to 2011, that corporations were on notice to be allowed to use this new methodology moving forward. And that was the legislature's intent, is to start using the economic nexus laws at the $500,000 level moving forward. And it was not a prospective decision, because I think, if we started down that path, then every law is going to have that same opportunity. So, we just passed, cannabis laws that are going to be effective 2018. So, in that sense, then we're going to say that, well, everybody who's here now in 2015 should be allowed to apply the 2018 standard, even though it's not effective until 2018. I mean, we kind of keep going down that pathway. And so I think in the legislature, we all served in the legislature, and I'd love to hear members' opinions on it, but that is usually my understanding, is that we are setting the law, we set an effective date, and we want everyone to kind of abide by it and play by the same rules, that we want consistency moving forward. And that's why we, either clarify laws or, create new laws, so that everybody is on the same page. So that's kind of my interpretation of the law.
Member Stower.
Thank you. Not that I was in the legislature, but that's how I was looking at it too, is that it had a 2011 effective date, providing businesses with the opportunity to change their business practices, change their accounting systems, so that everyone will have an opportunity to apply the law starting 1/1/2011. I think it would be an injustice had they not had that opportunity to change their practices. It would also be an injustice if we were to allow the change for the 2007 year and open the door for potential audits or claims for other taxpayers, when that was not the law of the land in 2007. I see the appeal of grace and the appeal of Dresser to be controlling for 2007 and 2009. And one more thing, I also feel that when the appellant went to the Franchise Tax Board and asked for the special relief, the petition, they were provided with relief. And in that notice of determination, the Franchise Tax Board was clear on their concern about lower income, and that's why they put in the throw-out rule. If the appellant or the taxpayer at that time did not agree with that rule, they had the option to file a petition before the three-member board and ask for additional relief, and they chose not to do so.
Member Runner?
Yeah, I guess to the taxpayer, and I'm kind of following the same kind of concern in regards to when the legislature puts does indeed extend a date of implementation, it's with purpose. It's not arbitrary. So I guess I'd like to hear from your perspective why you believe then if it was to be applied prior to implementation, why did the legislature, in your mind, decide to create that 2011 date?
Yeah, I think I agree with each of the members' comments about the legislative intent. I think the legislature intended for California jurisdictional purposes to exercise that jurisdiction effective only 1/1/2011. I think there's a different question, which is here, did California's sister states have jurisdiction to impose a tax under 25/1/22? Did it have jurisdiction prior to California's decision to exercise that jurisdiction effective 1/1/2011? Those are two different questions, and I think the legislature's decision in 2009, its recognition that it had the power under the Constitution to make this decision, tells us that the sister states likewise had the same power. How they exercise the power is a different question. Washington did it in 2010. Oregon had done it way previously. That to me is the distinction. The effective date, and that is the reason why this case has very limited impact. Inbound taxpayers who haven't filed because they didn't have physical presence, aren't going to be subjected to tax. And it's because the legislature was clear about a prospective effective date. We aren't asking for the statute to be retroactively applied. We're asking for the application of the plain language of 25/1/22, which is that we're entitled to apportion to any jurisdiction that had the constitutional authority to impose a net income tax on Craigslist. The FTB agrees that it could have been sooner. It didn't have. There's nothing magic from a constitutional perspective about 2011. The legislature recognized that in 2009.
Let me ask, in terms of your comment in regards to limited impact. FTB, I think in your comment, was concerned about a decision that might be for the taxpayer in regards to unintended consequence in other taxpayers. Can you expand on that?
Right, so if your board were to rule for the taxpayer, essentially what you would be ruling is that the Constitution permits economic nexus prior to 2011. So you would be overruling the only precedent we have that says physical presence is the requirement for inbound. And the standard for inbound, again, has to be the same standard for outbound. So that would be then the law in effect that FTB would then have to follow.
And as a result of that, what would happen?
Well, Senator Runner, I think the answer is that's probably above our pay grade, but...
What could happen?
What could happen is...
How's that?
Well,
I'll clean it up for you. Get it down to your pay grade. What could happen?
At a very minimum, as Katie indicated in her argument, taxpayers that did not file returns in the state because they had no physical presence here before, did not file returns in the state before 2011, and we agree and they agree that they were not taxable here, will suddenly be faced with a potential ruling from this board that says that if you have economic nexus, even before the legislature said that was going to be the rule, that you could be subject to tax. Now, how the Franchise Tax Board would react to that, I think would be a policy decision. It's our job to administer the laws, not to make the law. So with a decision like that from your board, I think we would have to have the internal discussions about what application, if any, your board decision might have for taxpayers that did not file returns. Should we contend that they do have a filing obligation? And then to address Craigslist's other point, that it would also generate, we believe it would generate, and actually we've already seen this, claims for a refund where taxpayers, not in Craigslist situation where there's an alternative formula, but filed using an economic nexus standard for their outbound sales, filed using a physical presence standard for their outbound sales, now would come in and say, okay, well, we're like Craigslist, so we want a claim for, we want a refund on the basis of using the economic nexus. So our point is that we don't have a crystal ball and aren't able to predict actually how events would go, because I think that would be a matter for the administration and the executives of the Franchise Tax Board to decide. But it would create a tremendous amount of uncertainty for staff in dealing with those claims for a refund, as well as the, we have whole divisions whose job it is to pursue people who have a filing obligation that haven't filed. So it would create uncertainty both for taxpayers and the Franchise Tax Board in terms of what would be the proper method to proceed.
I guess one of my concerns here is that I believe one of the important parts of what we do and what we should be doing and what is creating clarity. And I guess that's kind of what I'm concerned about. I'm concerned about if we go down this path that we are creating uncertainty and some issues of potential exposure to which taxpayers wouldn't believe they would have. I appreciate the fact that we don't know what the FTB would do. I guess it scares me enough to know what they could do. And I guess that's where I have my concern.
Member Harkey.
I'd just like to clarify, refunds have a 4-year statute of limitations, do they not?
Correct.
So we wouldn't be facing refunds? Because 2011 forward, the law, in your mind, is clear.
Member Harkey, many corporations have statutes of limitation. Statutes can be open for several reasons. The 4-year statute is correct, but typically corporate audits take quite a long time, as you know, cases come before you.
There's extenuating circumstances.
Yes.
So what we're really talking about here, I mean, if we break this all down, we're talking about, what, 7 states or Washington, D.C., and 6 states. And in 2007, I mean, negating what California did, but in 2007, did they have jurisdiction to tax? And Craigslist is saying, yes, they did. And you're saying because they didn't tax, they didn't have jurisdiction.
No, so we're saying that, on 25 and 122, there's 2 tests. One is you actually pay a tax, and then the second test, that's the test we're talking about. And we're saying, no, under our authority, California authority requires a physical presence to be considered taxable under U.S. constitutional standards.
If I could take a quick summary on that, I think what our position is that California authorities that interpreted the state's jurisdiction to tax before 2011 required a physical presence. That's what our position is. And other states, we have to acknowledge, implemented a different decision, but the courts and this board, when that issue came before it, prior to the legislature's action in 2009, effective 2011, have uniformly held, without exception, physical presence. And California case law is clear that California interprets its jurisdiction to the tax to the full extent permitted by the Constitution. So our argument is that the extent of the Constitution, as interpreted in binding California authorities, required physical presence until the legislature changed the constitutional principle in 2011.
Okay, and if these 7 municipalities had taxed, would we be here?
No. We would recognize
Because that would be the 100% you were talking. But see,
Right.
this is where I've got a problem with the analysis, but I can also count. Thank you.
In addition to what Member Ma has articulated relative to the concerns of the legislature and Member Runner, there's always a concern about determining whether or not something should be retroactive, because the activities of the legislature as well as the Board of Equalization has a double-edged sword, and it sort of cuts both ways. The other thing that was under consideration, as my understanding during 2009, was to attempt to give Congress some time to take action. And so there was legislation before Congress to determine, and so the legislature said, well, okay, as part of the negotiation with folks like Amazon, let's see what happens in Congress. And if nothing happens, we're going to take action. The challenge that we have before us is that there is a constitutional determination, and the constitutional determination is that it requires physical presence. The determination by various different, and California Supreme Court has not taken a position on this legislation yet. So we're yet to know whether or not there is, this is constitutional, the action of the legislature, which is up for whole nother debate, but it certainly fits in here. So the determination is on the actions of the legislature and the effective date of their decision. The legislature contemplates many things over a period of time, but when they establish a date, that's the date in which it is enacted. That's the date in which their determination or their thought process or their intention is meant to go into play. If you take a look at the Quayle case, which is always up for debate,
The
Quayle case, my apologies, the debate there is that, which came down to say that it requires physical presence. But the debate there was, my understanding at least, is that at some point, economic presence becomes physical presence by virtue of their activity, by virtue of their accounting, by virtue of their engagement in that city. So when you look at the greater purpose, the greater intent, the larger goal, at some point, your activity in that state becomes economic presence. And so therein comes into a question, had we evolved to that point? I believe the legislature just simply said, we've evolved. In 2007, we weren't there. In 2008, we weren't there. In 2009, we weren't there. And we believe by 2011, we should be there such that the economic presence in California is so substantial that it does create physical presence. And so the inherent challenge here, which we can't take up because we can't determine the Constitution, what we can only look at, in my view, is the date in which the legislation was enacted and the intent it established. The legislature said in 2011, there is physical presence in California, and let us define physical presence. That physical presence is defined by your economic activity and a number of other activities. I don't see a deviation from the Constitution as it relates to physical presence. So it's difficult for me to really, as far as case law and as far as the U.S. Supreme Court and so forth, it's just a challenge to get the argument that we can interpret the Constitution and we can make that interpretation retroactive. An inherent challenge with that argument, but that be as it may. Further discussion, members? Hearing none, is there a motion?
Move to take the matter under submission.
Member Stowar moves to take the matter under submission. Second by Member Harkey. Without objection, members, such will be the order.
Thank you, Mr. Chairman, and happy holidays to all of you.
Thank you. Same to you. Thank you.
Be there at 1:30.
Winterfest.
You don't have to.
Winterfest.
And then just go show up over there. And then you show up over there.
Yeah, that sounds good.
Good.
Maybe, yeah.
Tried.
Good.
Once again, I should have called you.
The board will recess for 30 minutes, and then we will take a break, a lunch break from 1:30 till 2:15. Okay, and we'll see everyone back here at 2:15. The meeting of the Board of Equalization will reconvene. Members, before we get started, just wanted to give a shout out to everyone who planned the Winterfest. The Board of Equalization once again is raising food, funds, and money to help those who need it the most and just doing an exceptional job. But the intricacy of pulling and organizing something of that magnitude requires dedication, commitment, and just thoughtfulness. And so to all of those who participated and worked to make that happen, thank you so very much. Yeah, thank you. Ms. Richmond, what is our next matter?
Our next matter is item B2, Hexu Zhao. Please come forward.
As the taxpayer comes forward and settles in, we would ask that Mr. Johnson introduce the issues in this case.
Good afternoon, Chairman Horton, members of the board. The issue in this appeal is whether appellant has shown error in respondent's determination that he was a California resident beginning May 11th, 2008.
Thank you. Thank you. Welcome to the Board of Equalization. You will have 10 minutes to make your presentation. Please be advised that we will return and allow you 5 minutes on rebuttal. We would ask that once you're settled in and at your convenience, you would introduce yourself and begin your testimony.
Yes, good afternoon, Mr. Chairman, board, opposing counsel. My name is Joseph Bray. Excuse me. I represent the appellant, Hexu Zhao. I'm his counsel. So 7 years and 7 months ago, my client sold stock with a capital gain of over $6.7 million. He sold the stock on May 16th, 2008. The respondent audited my client's return. He filed a Form 540 non-resident return, and they determined that he was a resident of California for the period of May 11th through December 31st of 2008. In that same audit, respondent determined that my client was not a resident of California for January 1, 2008 through May 10th. Now, on May 16th, my client sold his stock, and 5 days earlier than that date, respondent found that he was a resident of the state for tax purposes. So this is an interesting case. It's a pleasure to appear before this board. The law in this case is centered around Revenue Tax Code 17041, which is that a tax is imposed on every resident of the state of California. Residency is defined in Revenue Tax Code Section 17014A. A resident includes every individual in California that's here other than a temporary or transitory purpose, and every individual domiciled in California who is outside of California for a temporary or transitory purpose. Now, domicile, as you know, is different than residency. And I want to make it clear to the board, we are not disputing we are not disputing domicile. Mr. Zhao was domiciled in California. It's his home. It's where he intends to return. And he was a previous resident of California prior to 2006. Mr. Zhao is Chinese. He's a Chinese citizen. He's a United States citizen. He lives and works in China. He lives and works in China right now. In 2006, he took a job from JA Solar, a Chinese company. He lived and worked and moved from California to China in 2006. In 2007, he was with the same company, and he was deemed not to be a resident of California by the respondent in 2007. In the first half of 2008, prior to the period at issue, he took a new job. He took a job with Legend, and that job was offered to him, and he signed an offer letter on April 10th of 2008. When Mr. Zhao became a resident of California, or when he started, potentially a resident, when he started the job at Legend, is a disputed fact. So is Mr. Zhao a resident or not? That's the question that the board has to determine. And I think based on the facts and circumstances of this particular case, I would argue that he is not a resident for the period at issue, May 11th through December 31st of 2008. And what's most important that I want the board to focus on is Mr. Zhao's connections to China, as well as his connections to California. Now, the case law looks at these various connections, and these connections to California are important when determining residency. The Noble versus Franchise Tax Board case is an important case. It looks at all the totality of the circumstances are to be looked at. Another very important case that this board decided is the appeal of Stephen Bragg in 2003. In the appeal of Stephen Bragg, there's various factors. They're non-exclusive factors, but they're factors that this board has used to help it out and make a determination, is this taxpayer a resident or not? Now, there are a lot of factors here in this case that are the same prior to May 11th, 2008 and after May 11th, 2008. And yet we do have the Franchise Tax Board finding that he was a non-resident in the first half of 2008 and in 2007. What's important to look at with these distinctions is that you're going to hear from respondent a whole bunch of things that my client did after he took the offer at Legend, when he signed that employment offer on April 10th, 2008, and they're going to say, well, he intended to come back to California. And his intent and his acts show that he reestablished residency in California. Now, the famous case, Noble versus Franchise Tax Board, talks about a unity of facts or unity of acts and intent. Well, my client did not intend to reestablish residency in California. He worked for Legend as its CFO. He was to work for Legend for the period of making the company go public and finish its IPO. At the time, the company was headquartered in Fremont, California. It's now Sunnyvale. He was to work in Fremont because that's where the company's attorneys were that were going to make it go public and do the paperwork. He ended up leaving earlier than what he intended and left in October of 2008 and then went back to China, and he's no longer working for Legend. Now, respondent's going to put heavy emphasis on what the intent is of that employment contract that he signed. Nowhere in that employment contract does it say it's for a term of years. It's probably at-will employment. It, in fact, in one spot says there is no specified time. Respondent's going to say that since there are stock options that would vest in 4 years or earlier within 12 months after going public, that the intent of that contract was for an amount of time, maybe permanent, maybe not, but some duration of time whereby, coupled with the acts of signing that agreement and then coming back to California and doing some other things in California, that with the intent shows that he's now a resident of California commencing May 11th. The respondent's going to say that he bought a larger house after he sold the stock in California, and he bought a brand new car. He did both of those things. That's not disputed. He had just made over $6.7 million by selling stock and stock options that had vested from the previous company they had worked for, JA Solar. He bought a larger house of 4,286 square feet from his current home at the time of 2,080 square feet. The house was valued over $1 million. He bought a brand new BMW on May 11th, or actually, yes, May 11th, 2008, BMW X5. However, when he came here, he never changed his ties with China. He continued to own property in China. He owned an apartment. He continued to file a tax return in China. He had a Chinese driver's license. He had banking accounts in China. He lived and worked in China. That's where his job prospects were. That's what was best for the livelihood to support his family. His wife and 2 kids always were in California, even during the period that the respondent determined that he was a resident or a non-resident of California. His wife and 2 kids were in California, even during that period. Now, the respondent would like you to believe that by him buying a brand-new car and buying a bigger home, those are facts to show more enhanced connections with the state of California. I don't think those facts by themselves are determinative on residency. What I think is most important, and what the Noble Court laid out, as well as the appeal of Bragg by this board, is to look at the whole totality. If you look at his connections in China, he never severed those connections. If he wanted to reestablish residency here in California, why didn't he sell his home in China? Why didn't he stop traveling to China? Why did he continue to file a return in China? His address on his 540 non-resident return for 2008 was a Chinese address. Now, the state's also going to say that he made an admission on that filing of that tax return because he put that he became a non-resident on November 18th of 2008. Now, it's my understanding that that's a mistake. I don't know why he did that. I didn't prepare his return. He had a CPA. His CPA, I assume, is not a tax lawyer like I am or Mr. Riley is. And my client's definitely not a tax lawyer. Residency is very important legally. However, I don't believe that that's an admission because the period prior to that, especially the first half of the year, respondent found him to be a non-resident of California. So that's not an admission that's determinative in my view of this case. I also want to look at and let the board look at in the exhibits I submitted. There's 3 different letters to look at. One is the offer contract of April 8th or April 10th, 2008, and there's 2 letters. I inadvertently, and I apologize to the board, did not include the second letter in my Exhibit F, and that second letter was dated June 7th, 2011, and that's by the human resources person of Legend saying when Mr. Zhao's start date was at Legend. And then there was another letter on January 9th, 2012 that says what his start date and end date was. The offer letter he signed, the job was to commence May 19th. That's 3 days after he sold the stock. The June 7th, 2011 letter says the commencement date was to have started May 12th, his job of 2008. The second letter, the January 9th, 2012 letter, says he started his job on May 19th. So the question is, well, when did he start working for Legend? And is that date that he started working for Legend, is that determinative of residency? And I would argue it's not. In and of itself, it's not. It's one factor. However, if we look at dates or look at cars or look at houses, we have to also remember he never did anything or changed anything in China. He came back to California and he was here, I would argue, temporarily, transitory, working for this company until it went public, its IPO, and then he was to go back to China, work for that company, same company, but in their offices in China. He was not reestablishing residency.
Time's expired.
Thank you.
We will return and allow you 5 minutes on rebuttal. Members, let's go to the department. The department has 10 minutes to make their presentation. We'd ask that you commence with your introduction. For the record, please.
Good morning, Chairman Horton, members of the board. I'm Jason Riley. This is Ron Hofstall, and we represent California Franchise Tax Board in this matter. The legal question in this appeal is, was Mr. Zhao a California resident? California imposes a tax on the entire taxable income of all its residents, and to define a resident, California first asks, is the individual domiciled in California? Mr. Zhao is a U.S. citizen domiciled in California, so his domicile is not in dispute. He was at all times domiciled in California. Since Mr. Zhao has conceded California domicile, the next question is, was this individual who is domiciled in California outside California for other than a temporary or transitory purpose? The objective facts show that when Mr. Zhao was not outside California when, on May 16, 2008, he sold 300,000 shares of JA Solar stock resulting in capital gains of over $6.7 million, which he excluded from his California returns. In addition, as will be clear, all Mr. Zhao's closest connections, his wife, his 2 children, his homes, his job, and his presence are with California. Because it's undisputed that during this period, Mr. Zhao was living in his California home with his family and working for Legend Silicon USA in Fremont, California. His domicile, his presence, and his purpose are all in California. Unlike the 2007 tax year, where Mr. Zhao's residency status hinged upon a safe harbor exemption, that exemption would not apply to the 2008 tax year because, among other things, his employment in China ended on May 8, 2008. He was not working under a foreign employment-related contract at the time he sold the JA Solar stock. Since Mr. Zhao was domiciled here, recall that he was a California resident unless he demonstrates that he was absent from California for other than a temporary or transitory purpose. Applying the facts to the test, first, Mr. Zhao was not even outside of California at the time he sold the stock, and thus could not be absent for other than a temporary or transitory purpose. Second, once his employment in China ended on May 8th, he returned to his California home, to his family who resided in California, and started a new career for a California employer, Legend Silicon USA, based in Fremont. The moment he returned to California and he's no longer employed in China with JA Solar, his residency status resumed because his closest connections were always with California. After he returned to California, Mr. Zhao spent the bulk of his time, 73% of the days at issue, in California. Remember, for an individual domiciled in California, the test is, was he absent from California for other than a temporary or transitory purpose? Here, the answer is no, because Mr. Zhao was not absent. He was present in California when he sold the stock through his California brokerage account, the mailing address of which was his Fremont home. Under the law, Mr. Zhao was a California resident. Although the test for determining residency is quite clear, Mr. Zhao's briefs would like you to use a test for individuals not domiciled in California. In a nutshell, that test asks, why are you present in California? Remember that Mr. Zhao has conceded California domicile, so the proper test asks, was he absent for other than a temporary or transitory purpose? The objective facts show that his domicile, his purpose, and his presence are all in California. Prior to the period at issue on March 24, 2008, he renewed his California driver license. Then, a month before quitting his employment in China, on April 6, 2008, Mr. Zhao interviewed for a position as Chief Financial Officer with Legend Silicon USA of Fremont, California. He accepted employment with Legend Silicon USA on April 10, 2008, when he transmitted acceptance to the company's California headquarters. Mr. Zhao had just severed his primary connection to China. He quit his job there. As noted in JA Solar's press release of April 11, 2008, he quit so he could move back to California. His final day of employment in China with JA Solar was May 8, 2008. Then, on May 11, 2008, Mr. Zhao left China and physically moved back to California. He returned to his marital abode to live with his wife and his 2 children, who are all California residents. The same day, he purchased a new BMW SUV in California, and he started working at Legend Silicon USA in Fremont on May 12, 2008, according to his own business calendar and the company's own human resource department. Note that each of his California connections was in place prior to the stock sale on May 16, 2008. He was not severing ties. He had resumed his existing ties. He had essentially stepped back into the comfort of his California residency. In his attempt to change the analysis to focus on what he was doing in California, Mr. Bray has stated that Mr. Zhao tried to minimize his relationship with Legend Silicon USA. For example, Mr. Zhao has claimed his employment with Legend Silicon USA was, quote, a temporary position, and that the contract was, quote, only for a temporary period of time until the company's initial public offering. The objective facts do not support Mr. Zhao's contentions. In California, a contract can either be at will, that is, for an indefinite term, or it can be for a specified term. There is no evidence in the record of a temporary or specified term in his Legend Silicon USA employment contract, as Mr. Zhao has suggested. To the contrary, the April 10, 2008 employment agreement expressly stated employment with the company is not for a specific term. Moreover, the agreement makes no mention of China, The employment contract clearly states it is an offer for employment at Legend Silicon USA, whose offices are located in Fremont, as the CFO. Mr. Zhao's salary was listed in the agreement as $180,000 per year. The agreement relies upon and specifically references U.S. law, not Chinese law. The agreement was expected to last 3 years or more because his benefits, which included 160,000 shares of stock options, had a vesting schedule of at least 3 years. And Mr. Zhao was employed to make an outstanding contribution to Legend Silicon USA's, quote, success and growth. The agreement expressed excitement about the future and clearly supports the parties' intention, and clearly supports the parties' desire that Mr. Zhao would be employed long-term as CFO of Legend Silicon USA. Still, Mr. Zhao's starting date at Legend Silicon USA is not the controlling factor here, but it is one in a series of important factors. According to his own business calendar, which I've provided for you as a hearing exhibit and highlighted the date on which Mr. Zhao stated that he started, and the company's own human resource department, he started at Legend Silicon USA on May 12, 2008. Mr. Zhao has advocated that his closest connections were in China. Your board has looked to the taxpayer's closest connections in the appeal of Bragg. Yet under the Bragg factors, we reach the same conclusion. Mr. Zhao's closest connections were with California, and he was a California resident. In conclusion, the significant ties to California that Mr. Zhao maintained included the undisputed fact that his wife and his 2 children lived in Fremont. His marital abode was a 2,000 square foot home, and then he bought a new 4,000 square foot home for $1.99 million, and they're both in Fremont. He had the employment contract to work for Legend Silicon USA in Fremont. He purchased a new BMW SUV in California. He's claimed the homeowner's property tax exemption from 2007 through at least 2010. He admitted on his California tax return that he was a California resident prior to November 18, 2008, stating that he became a non-resident on that date. And Mr. Zhao was physically present in California when he sold the stock and spent 73% of the days at issue in California. On the other hand, when we look at China, we see he had the temporary work permit, he had the terminated employment contract, he had an exit visa from China stamped in his U.S. passport on May 11, 2008, and he had the small flat in Shanghai. Under California law, Mr. Zhao is a California resident. His domicile, his presence, and his purpose are all in California. And respondent's residency determination was correct, and it's fair that Mr. Zhao contribute to California's support. And if I could just quickly address, Mr. Bray mentioned that Mr. Zhao continued to file Chinese tax returns. While JA Solar filed a tax return for Mr. Zhao from the period of leading up to May 8th, 2008, neither Mr. Zhao nor Legend Silicon, there's no evidence in the record of either filing a Chinese return for Mr. Zhao from the period of May 11th, 2008 onward. Thank you.
Thank you. On rebuttal, please.
Yes, thank you, Mr. Chairman. I want to first point out that Mr. Riley, the holding an appeal of Stephen Bragg, actually ruled in favor of the taxpayer. This board ruled that he was a resident of Arizona and not of California. So that's important because this case is very similar to Bragg, because in Bragg you had connections in California and you had connections in Arizona, and this board found that Mr. Bragg was a non-resident of California. Now, I want to go back to the Legend Silicon offer letter of April 10th, 2008, because Respondents' Counsel focuses heavily on this contract, and he said a lot of things that aren't in this contract. And I guess, basic contract interpretation is look at the 4 corners of the contract, and if you can't figure it out from the contract and the 4 corners, then you look to the intent of the parties, okay? Respondents' Counsel is substituting his intent or his client's intent into this offer letter. In Mr. Riley's version of the offer letter, you would think that he's going to be in California, Mr. Zhao, that this employment with Legend is only for Legend in California. It doesn't say anything about California. It doesn't say anything, with respect to China. It's silent on exactly where this is to be carried out. Yes, it was signed and delivered from Fremont, California, but at the time, that was the headquarters of Legend. They also have offices in 3 major cities, Beijing, Shanghai, and China. So we really don't know exactly what the interpretation is of where this job is to be performed. My client maintains it was to be in California for a short duration of time until the company went public. Typically, it doesn't take that long for companies to go public. It's a transaction, there's a matter of time that it's done, and it goes public, okay? We don't really know, okay? It's for this board to look at this offer letter, and I have it in my Exhibit E, and I would rely on the board to review this offer letter specifically and look at the testimony of Mr. Riley and see, is this offer letter everything that Mr. Riley says it is? I would argue it's not. Now, as far as domicile and residence, the way I understand the law is that since he is a domiciliary of California, if he comes back to California and through all these tests and connections, the Noble case, the Bragg case, and the other cases on this, if he reestablishes residency because he's here for something more permanent, not temporary, that he's here, he's reestablished himself, he's availing himself of the laws of California, then residency would be reestablished. I don't believe that he reestablished residency here. He previously was in China the year prior, earlier in the year before he took this job, and he had many of the same connections in California that Mr. Riley emphasizes in the period of time that respondent found him to be a non-resident. What's changed? Well, he took this job offer, and we don't really have specific information in the actual letter of when it was to start versus the letters that were received and provided to the audit division. And so it's really left for you, the board, to determine as a trier of fact of sorts of what, based on the underlying record, what is Mr. Zhao coming back to California for? Because he ends up leaving California 5 months later and goes back to China. And he never sold anything, changed anything in China, never got rid of his property in China. Those are all things you typically do if you're coming back to reestablish residency. I have nothing further. Thank you.
Thank you very much. Discussion, members. Member Harkey.
Hi. Mr. Zhao had wife, children, home, car, job in California, took the homeowner's income tax or property tax exemption. And in 11/18 of 2008 is when he signed that he was non-resident. Now, I'm having a problem. I guess I'll ask this question, as rude and out of context as it may be, did he have wife and children in China?
Well, it's a good question, Member Harkey. No, not that I'm aware of. But I will say...
I just want to clarify that we don't have 2 residents. We seem to have had one, at least one we're willing to admit to. So I have reviewed this, and whether or not there was a May 11th, May 12th, May 19th start date, he was here, was he not, when he sold his stock? He was here.
He was here in the state of California, yes.
Right, his wife and children, his home. He had a job. This is really different than the cases we've heard where they've been a little bit more, let's say, less clear, where you could really, I would have a real hard time supporting this. I just don't see that he wasn't a resident, and I will defer to my other board members.
Further discussion, members? Hearing none, is there a motion? Ms. Stowart, move to take the matter on submission, second by Member Harkey, without objection, members? Such will be the order. Thank you very much for appearing before us. The board will take your matter under consideration later on this evening and send you a written report of our decision.
Thank you.
Thank you, members.
Ms. Richmond?
Since items B4A and B4B were pulled, our next item is item C, Sales and Use Tax Appeals Hearings. Item C1, ROX LLC, please come forward.
As the taxpayer comes forward, Mr. Njija, would you please introduce the issues in this case?
Good afternoon, Mr. Chairman and members. I'm Jeff Anjija on behalf of the Appeals Division. The appeal before you presents two unresolved issues, which are whether adjustments are warranted to the amount of unreported taxable sales and whether the department has established fraud by clear and convincing evidence.
Thank you. Welcome to the Board of Equalization. Please introduce yourself for the records. Subsequent to that, be advised you'll have 10 minutes to make your presentation at your convenience.
Thank you, Chairman and members of the board. My name is Jesse McClellan, counsel for Petitioner, ROX LLC. I'm joined today by Heather Donneville to my immediate left, and her left is Koji Nomura, two former members of the LLC. We're here today to contest the fraud penalty that was added to the audit. We're requesting that the board reinstate the negligence penalty that was initially applied in the audit. Now, the department has the burden of proof to establish fraud by clear and convincing evidence. Clear and convincing evidence requires evidence so clear as to leave no substantial doubt as to the presence of fraud. The presumption is always in favor of good faith, fair dealing, and honesty. The board's published policy under Chapter 5 of the Audit Manual specifically says that when addressing a fraud penalty, with respect to the factual issues related to it, any doubt should be resolved in favor of the taxpayer. We believe that the department resolved any doubt in favor or against the taxpayer in this case, which is what resulted in the fraud penalty. And when the proper standard is applied, it will be clear that the fraud penalty does not apply. The taxpayer operated a bar and restaurant in downtown Santa Barbara during the period in question. Mr. Nomura, who is here with me today, was responsible for handling the kitchen matters, for managing the kitchen staff, for acting as the chef, creating menu items, and ordering food. Ms. Donneville's primary responsibility was with managing the service staff, which included setting schedules for waiters, bussers, greeting guests as they came to the restaurant, and also waiting on tables as necessary. Neither had any formal education or training with respect to accounting, tax, or bookkeeping matters. The business was selected for audit in 2007, which was the taxpayer's first audit. Ms. Donneville met with and interacted with the auditor throughout a several-month time frame, spending numerous hours with the auditor during that period. An understatement was ultimately established in the audit, but the auditor, in preparing the audit, specifically found that there was not evidence to support that the errors were intentional, and stated that the errors were due to negligence. That conclusion was discussed with two supervisors. His immediate supervisor at the time signed the comment, stating that she concurred with that recommendation. The audit then went through the district level review and was ultimately sent forward for billing. Prior to the billing being issued, the district principal auditor ordered that a fraud penalty be added to the audit, sent it back to the auditor for that to be done. So we have a situation where you have a senior tax auditor that meets with and spends a number of hours with the taxpayer and thoroughly addresses and deliberates about the penalty with his supervisors, two separate supervisors. There's also an audit reviewer involved. and concludes that the errors were the result of negligence and that the errors were not intentional. You then have an individual that had never met with, never spoken with, never interacted with the taxpayers that concluded that fraud did apply and ordered that it be applied. We believe the person under that scenario with the best ability to make the right decision is the person that met with the taxpayers, that talked with them, that interacted with them, and that was the auditor in that case. And it wasn't the auditor making a decision in a vacuum. The auditor had discussed it with his supervisors, and they all reached the same conclusion. Now, in support of the department's fraud penalty that was added to the audit, there were a number of factors that were looked at to support it that we now know are inaccurate. To begin with, there was a claim that tax reimbursement was added to all of the sales. Before you today is Exhibit 3 is an example of the restaurant receipts, which make it clear the tax was not added to anything but food sales. So we have a situation where the taxpayer didn't collect tax on the portion of the sales that were underreported. If you look at the food sales that were taxed of the business and you compare it to the sales that were reported, you have a close reconciliation. And I can get into the details of that and more. But under the circumstances, tax was not added to anything but food sales. There was also a claim that there were 2 sets of records. That's not true. There was a claim that Ms. Donneville had a degree in accounting. That's not true. There was a claim that Ms. Donneville was a professional bookkeeper. That's not true. There was a claim that Ms. Donneville maintained the books and records of the business. That's not true. Finally, the department said that because at the conclusion of the audit, the reported figures increased, that supports that there was fraud. We think it shows the opposite. We think it shows that after the first audit of this business, and having interacted with the auditor and recognized the errors that occurred, that it shows good faith and that the taxpayer was willing to do what it needed to do to accurately report. And in that case, they hired somebody outside of the business to handle the reporting going forward to make sure the similar errors didn't occur. In summary, we have a situation where an experienced auditor and his supervisors that had a direct connection to this case spent numerous hours with the taxpayer, deliberated about the penalty, came to the conclusion that the errors were not intentional. We then have an individual that's disconnected from the case, that never met with, never spoke with the taxpayers, makes a conclusion that fraud should apply, apparently merely on the understatement. The law specifically says that a fraud penalty should not be based merely on an understatement. And then it bases the fraud penalty or seeks to support the assertion of the fraud penalty on facts that are simply inaccurate. They've been established to be inaccurate. Because there wasn't fraud, and because the department hasn't supported its claim that there is fraud by clear and convincing evidence, we ask that the board delete it from or remove it from the audit. Thank you.
Members, we'll now go to the department. The department has 10 minutes to make their presentation. We ask that they commence with their introduction for the record.
Thank you, Chairman Horton and members. My name is Scott Lambert. I'll be representing the Sales and Use Tax Department today. To my right is Kevin Hanks, also with the Sales and Use Tax Department, and to Mr. Hanks' right is Stephen Smith with the Legal Department. In this particular case, the taxpayer operates a bar and restaurant. It was audited for a 3-year period. As the petitioner stated, the audit was submitted as with a negligence penalty initially. It went through the review process. Part of that process is any case that's over $50,000 goes to the district principal auditor for their review. It went through his review, and then it also went to audit review. And at that particular time, the audit reviewer returned the audit to the auditor, having the auditor explain or provide an explanation for such a large error. There was close to, well, during that time, there was a substantial liability. The auditor was told several things, which is at dispute now, but it was basically his explanation is he was told by the taxpayer that she had intentionally underreported the tax. She was afraid of being criminally prosecuted, which was a valid claim. This is a felony level tax liability. So there was that issue. She had stated to the auditor that she had received, I believe it was schedules with numbers on them from her ex-husband that she used to report from. So, and we don't believe that we need to use any of that to support our case here. I'm merely mentioning that as that's kind of the background of, it's documented in the case, and it's the background of kind of how we got here. So when the auditor first turned in the audit, they had conducted a 3-year audit. When they went back to the date that they first started, which was May of 1998. The audit shows almost $6 million in sales, taxable sales that were not reported for that particular period. The taxpayer's point of sale system treats sales in the dining room as subject to tax in that it adds the tax to those sales. The sales that are made from of alcohol in the bar location is treated as tax included. This is really no different than what most bar restaurants do. Some have slightly different, but a lot of times when you go into the bar portion, if you bought a $6 drink, you would pay just $6. If you took that drink over to the dining room with your meal, they're going to take the $6 and charge you tax on that. So for the taxpayer's system, it showed all sales as being subject to tax. So if it was sales of alcohol in the bar, it broke out tax separately and put it into the accrual account. So the auditor used, and they have the POS system, and then they also have a QuickBook system, and they use the figures from the POS system to go over to the QuickBook system, and that's a majority of the liabilities established from that in the audit. Because of the time periods and the lack of records for certain periods, we had to use both income tax returns and profit and loss statements. So what we found for 2004, 2005, and 2006 is that the sales that were recorded in the general ledger were the amounts that were reported on the income tax returns. And the amounts that were reported on the income tax returns did not include sales tax. So all their sales of sales tax, they took the tax out of that. So they took a deduction on their income tax returns for the sales tax that they're now saying that they did not collect. And that's supported by the facts. As far as the receipts that are provided, there were receipts that the taxpayer has provided, but we're unable to determine from those where those sales took place. So if they were in the bar portion of the business where they're charging tax and there's no extra tax or no separately stated tax for the drinks, that would be consistent with someone having their meal and drinks inside the bar area. So there is no evidence that the taxpayer has provided to show that there were sales of food where tax was not added to those sales of food. So consequently, their argument now is, and I'll say this was not their argument at the time of the audit, it wasn't the time of the first appeals conference, and it wasn't at the time of the supplemental appeals conference. This was made after the supplemental, where they now state that they use the POS system to report. When they were asked at the first appeals conference, let me take one step back. At the audit, they told us how they reported, which was basically from a piece of paper that was provided. And I don't know what the origination of those numbers came from. I know who the auditor said they came from, but I don't know what substantiates those numbers, if they were just made up or they came from something else. So they don't tell us that they're reporting from the POS system at that particular time. At the first audit, they're asked, where do you report from? It said, I don't know where we got the figures from. It's documented in the DNR, the decision and recommendation. It's not until later that it's the POS. And what I would point out, if you look by individual year on what the recorded food sales are and what's reported as taxable, there's sizable difference in each one of those years. And use 2005 as an example. The taxpayer had recorded food sales of $821,000. They reported $556,000 as taxable. So not only did they not report any of their alcohol sales, which is, I believe, over 50% or somewhere in that range. They didn't report any of their alcohol sales. They only reported 70% of their food sales. So there's a sizable difference between what they reported and what they show as food sales in their books. Now, the department believes that the fraud penalty should be based on the facts and not what happened initially. There's the badges, or what you call the badges of fraud, which is, we have three different areas here that we have, that we believe apply. The first one is a substantial discrepancy between recorded amounts and reported amounts, which cannot be explained. And we don't believe the explanation that has been given, we don't believe it's a credible explanation. Tax or tax reimbursement properly charged. So the argument that they're making now is that the sales from the bar area didn't include tax because there was no sign. There's no question that the taxpayer thought the sales were taxable, that they thought they had collected tax, that their system, the POS system, reflected that tax was collected, and that for income tax purposes, they deducted amount for sales tax, or basically netted it from their reported sales. That's without question. And then also, they had accrued the tax in their returns. And so during this period of time, there was $600,000 that went into their account that was never paid to the Board of Equalization. The department never claims that there was a second set of books. We believe, our position is that the general ledger figures that they provided to us are the actual sales of the business. The taxpayer cannot show where the figures that they reported, where they came from. The taxpayer also argued that they believed that there was negligence. So at a minimum, if you find, and we don't believe you will, but if you do, find that there was no fraud involved here, we believe that at the minimum, a negligence penalty would apply. We'd also point out that the fraud penalty opens numerous periods with the statute of limitations, and that if the fraud penalty doesn't apply, there would be a number of periods that would outlaw by statute, and that, just to bring that to your attention. There was a lot of things in this case. I mentioned some of them. I am available to answer questions if you need to. And that, with that, the department concurs with the Appeals Division decision and recommendation.
On rebuttal.
Thank you, Chairman. I don't think I'm going to have enough time to address all of the disagreements that I have with what was just said, but there was a example of what we've dealt with here. Mr. Lambert stated that they can't tell where the sale took place in the restaurant on the receipts. Number one, I disagree with that factually. If you look at the receipts, it indicates where the service took place, whether or not it was at the table for, and this is Taxpayer Exhibit 3 that was submitted with the brief.
Excuse me, 1 second.
Sure.
Do you guys have the
I don't have taxpayer
exhibits? We don't have the
three.
exhibits.
You have a,
I submitted them,
I know,
geez,
we don't.
some
we
time
don't
ago.
Keep everything up here because it gets voluminous. Is there anything that we could maybe make a copy of?
Absolutely.
Being referred to?
Yes.
Ms. Richmond?
So they got it?
It's coming.
Okay. Aside from the fact that the receipts will show where the service took place, the way the department is looking at this is, well, we can't tell, and the taxpayer hasn't shown us anything otherwise to change what we're believing or what our presumption here is. So it's another example of taking a fact where, with respect to an audit liability, where the taxpayer bears the presumption of proof, it's different. In a fraud case, the fact should be resolved in favor of the taxpayer. So it's really not our job to qualm every suspicion that the department may have, although the receipts happen to do that in this case. With respect to the claim that Heather expressed concerns with criminal charges, he says it's in the record. I don't see that anywhere in the record. I do see allegations that are made after the fraud penalty was alleged. I've never heard it stated that way. We asked for the auditor to be made present today. The department responded through proceedings that it gets to choose who it presents before the board and that it doesn't choose to have the auditor available. After we raised that in various communications, we then received a subsequent email in which it informed us that the auditor is no longer with the board. That's contrary to anything that I've ever discussed with my client. The other claim was that Mr. Nomura was the source of the figures for the return. That doesn't make any sense. He was a chef. He didn't have any involvement in that process. It wasn't something that he was capable of doing. The department makes claims that the point-of-sale system provides certain information and phrases it as though there's information without question from the system. I have a hard time understanding how that conclusion is reached when in a memorandum dated June 14, 2010, the auditor states that the only records that were used to conduct the audit were the QuickBooks records. The only records. He doesn't make any mention of the point-of-sale records. And if you look at the audit and the audit working papers, the source of the information on those worksheets is exclusively from QuickBooks, or what's referred to as the general ledger, or the franchise tax board returns. So for the department to suggest that the point-of-sale system shows information that is without question, it must have seen or has something that it hasn't made available because I haven't seen it. The auditor apparently didn't look at it. So again, that's a fact that's being relied upon that can't be supported and is actually contradicted by the audit itself and by the auditor's own comments. We think the auditor made the correct conclusion when he said that there wasn't evidence to support that the errors were intentional, that the errors resulted from negligence. We ask that the board reinstate the negligence penalty, and I'm happy to answer any questions. Thank you.
Thank you very much, Mr. Njija. Just for clarification, can you articulate the badges of fraud, please? Only because, for the record, there are only 3 elements that have been brought forward by the department.
The audit manual specifies at least 6: falsified records, substantial discrepancies between recorded amounts and reported amounts which cannot be explained, willful disregard of specific advice as to the applicability of tax to certain transactions, failure to follow the requirements of the law when there's evidence of the knowledge of the law, tax or tax reimbursement properly charged, which shows knowledge of the requirements of the law, but the tax hasn't been reported, and transferring accumulated reported tax from a tax accrual account to another income account.
Mr. Runner.
Yeah, let me, take me through this discussion, or this issue in regards to the department, to the process for determining fraud penalty. I guess, I'm trying to remember, but I kind of should check back with staff and also the cases of appeals that we've had, and that is, it seems a bit unusual that the fraud penalty application or suggestion was made at the level to which it was, when it was that there were statements and documents by the auditor that indicated that there was not enough evidence. So I guess tell me what is that? Tell me how I'm seeing that as unusual. Is that unusual?
I think unusual. I think it's other than the norm. So I guess that could be considered as something somewhat unusual. But the system that it went through was not unusual. It was the usual process.
Right. In terms of how it went up the chain and review.
Right.
That's normal, typical. But
Right.
but the addition of the fraud penalty as it was going up that review process.
Right. But
that's what would be unusual.
Right. That's not my understanding of what took place. Is that the audit was submitted by the auditor.
Right.
Without with a 10% negligence penalty, without the fraud penalty.
Right.
It was signed off by the not his supervisor, but a supervisor signed off on it. I believe that the DPA would have to review that.
Right.
And then it went to the reviewer.
Right.
And at that time, I have the report from the reviewer that sent it back, and it doesn't direct them to add the fraud penalty. What it does is it says, please explain, essentially it says, and I can read it if you like, but it basically essentially says, hey, there's a large difference here without any explanation. And then they refer to the audit manual, which says whenever there's a large difference without, the larger the difference is, the more likely that it could be an intent to evade. And so we're asking you to address that area. When it did, they reconsidered it. And the auditor who attended the supplemental appeals conference concurred with the penalty being applied, and then gave the reasons for what he believed supported that, which was a fraud memo, which was signed by the district administrator and the chief of headquarters operations division. And those are required in order for that penalty to apply.
So at that time, that's when it went back down, that's when it would be that the evidence of fraud had to then be added or
you would have to
determined, I guess.
They'd have to prepare a report to substantiate the reasons for the fraud.
That they didn't believe were there in the first place.
The auditor stated.
And the supervisor.
And the supervisor. I don't know if, there was another supervisor that it was discussed with, and that supervisor said, make the decision. He made it. Subsequent to that, he said, I felt sympathetic towards the taxpayer, and that's why I didn't add it to the determination or to the billing.
Who said that?
the auditor.
Okay. Let me ask, in terms of the facts that were gathered then, and determined to create that are determined and stated then in the fraud memo, let me ask the taxpayer representative. How do you observe then those facts that are gathered then in regards to identifying the fraud penalty after the auditor didn't appear that it was basically the statement here says that he didn't have enough evidence to support the fraud penalty, was the quote from the auditor, but eventually then apparently he came back and found some more.
Right. Well, number one, the department references documents that weren't made available to me. If they have a go back from the reviewer, that's something that I haven't seen. According to the Z comments, there is a discussion with the reviewer, and then the supervisor makes a comment. This is outside of the audit. This is the assignment contact history. This is Exhibit 2, 1 of 1, taxpayer exhibits. I assume you guys were just provided those, but it says that, again, Curtis said that he didn't have enough evidence to support a fraud penalty. Now, to look at it after the fact, after somebody has essentially said, well, wait a second, you were wrong from the top down, I don't believe that that person's judgment at that point can be considered objective. I spoke.
You think that once they tell the auditor, you better go find some fraud? Is that what you're saying?
Yes. And I spoke with the auditor before the fraud penalty was recommended twice. And he didn't say, I thought fraud was present. I was just trying to be sympathetic for the taxpayer. And at the appeals conference, that's not what he said. Now, in a memo subsequent to that.
You don't interpret that the taxpayer representative saying, I think I should be, or excuse me, the auditor saying I'm sympathetic to the taxpayer does not indicate to you that he was overlooking fraud in his sympathy.
Well, what I'm saying is he never said that to me. He said that he was ordered to add fraud. And at the appeals conference, he did not say, I believed fraud to be present. I was only being sympathetic. He did not say that. Now, another person from the department wrote a memo that said.
Go back to that. During the appeals conference, the auditor said that he was told to add a fraud penalty?
At the appeals conference, okay, on the telephone with us,
okay,
he said that he was ordered to add a fraud penalty. We had discussions, communications with the auditor after the audit was submitted. We were hired. We communicate with the auditor. He then informs us that he's being directed to add a fraud penalty. At the second appeals conference, the auditor participated. His words at that conference were, he didn't initially think that fraud applied, but after looking at it further, he came to agree, was what he said at that time.
Okay.
Not that he, in essence, as I understand the department to say, I believe what they're saying is that, well, the auditor actually always thought it did apply. He was just trying to be nice to the taxpayer by saying that it didn't. That's not what was represented to us by the auditor.
Okay, thank you.
Yeah.
Further discussion? Here none. Is there a motion? Moved by Member moving too fast? Members, their discussion?
Move to take under submission.
Move taken under submission. Second by Member Runner. Without objection, members, such will be the order. Thank you very much for appearing before us today. The board will take your matter under submission later on this evening and send you a written report of our decision.
Thank you, Chairman.
Thank you.
Ms. Richmond?
Our next hearing is item C4, CBC Steel Buildings LLC. Please come forward.
As the taxpayer comes forward and settles in, Mr. Njija, would you please introduce the issues in this case?
Mr. Chairman and members, the appeal before you presents one unresolved issue, which is whether the disputed sales qualify for the partial exemption for farm equipment.
Thank you. Welcome to the Board of Equalization. Please be advised that you will have 10 minutes to make your presentation, and we would ask that you commence with your introduction for the record, please.
Good afternoon. I am Ron Martella, co-owner of Ron Martella Farms and Grower Direct Nut Company, which processes our walnuts. And to my left is Tom Constantino. He's our builder. Okay, the issue at hand I guess, and I don't envy your positions having to make these decisions from what I've heard. Kind of an educational day to day, but the issue at hand is that we built a building. Grower Direct, that company, built a building on our properties. Tom Constantino was our builder, and when we paid our bill for the building, our secretary inadvertently paid the sales tax. The building, as I understand it, is exempt from the sales tax. And the frustrating part that I have here is that it's always looked at as CBC Building is asking for the exemption, but it's actually Grower Direct Nut Company that is exempt. It's their building, and they're the ones that are exempt. And it's been hard to explain to the representatives of the Board of Equalization that it was Grower Direct Nut Company's building. It's real simple. I mean, as far as we're concerned.
Okay. Does that conclude your testimony?
Yeah, that's really all I have to say.
Thank you. Thank you very much. Members, let us go to the department. The department has 10 minutes to make their presentation. We ask that you commence with your introduction for the record, please.
Thank you. Mr. Chairman and members of the board, I'm Erin Dendorfer from the board's legal department, along with Lawrence Mendel and Kevin Hanks representing staff. We concur with the recommendation of the Appeals Division. The law explains that for the partial exemption for sales of farm equipment and machinery to apply, the sale must be to a qualified person, such as a farmer. In this case, the sales were not made to farmers, and that is not in dispute. The sales at issue were to a construction contractor. Therefore, the partial exemption does not apply. Accordingly, we request that the claim for refund be denied. Thank you.
In rebuttal for that, it's Grower Direct's net building. It sits on our property. We did pay the sales tax. If I would have caught it before the sales tax was paid, we would have readjusted the paperwork. And when we talked to the Board of Equalization to begin with, they said, well, get the paperwork changed and the exemption would be okay. Well, when we did the paperwork, the correction, then the paperwork was denied. Somebody at the board said they're not going to accept the new paperwork that was denied. So I don't know what else to say except that it's Grower Direct's Nut Company. We employ 300 people, and we're doing a lot of expansion in the company, and we'd like to get our money back. This has been going on for 4 or 5 years.
Thank you. Members, I only hesitate because I just want to make sure that the legal reason for the department's position is clear, whether we agree or disagree. I didn't necessarily get that out of their presentation. For the purpose of positioning the appellant to respond to that. But with that said, maybe I'll go to appeals, and maybe appeals can articulate why we're here.
For the exemption to apply, the law requires that the sale of the tangible personal property be to a qualified user. And in this case, the sale was to a construction contractor rather than to the qualified user. So under the law, it doesn't apply.
If I could add something.
Please. Now, let's go back to rebuttal.
Chairman, it was a mistake that was made. When we came in and started doing work at Martello Farms and Grower Direct, we didn't know about the tax exemption. Okay, so our normal procedure and the way we do business is we purchase the buildings from CBC Building System. They're a company in Lathrop. We buy the building package from them and turn around and sell it to Mr. Martello. I am charged the sales tax from CBC automatically. They didn't know, and neither one of us knew that it should have been a point of sale to Grower Direct or Martello Farms in order to get that sales exemption, tax exemption. Okay, so it was an honest mistake. It was caught after the fact. It was probably a year or two after the fact. And so it was a mistake that was made. We've tried to rectify it. It's $37,000 approximately that was paid by Grower Direct, Martello Farms, to CBC. And that's why CBC's name is on that, I believe, on the the claimant is because the sales tax was paid ultimately to them who paid the state. All right, so that's why the money would have to go back through CBC, back to grower direct in this case, which they've tried to tell the state that that was the case and that it was a mistake, but we're here now for this reason, and this is how we've come to this point.
Good. Thank you very much. Mr. Renner?
Yeah, just to, again, so again, if there was a way to do this, right? If there was a way to do this, what would have happened is the farmer, who is the qualified purchaser, right, would have bought the building, right? And then the contractor then would have erected the building. And then the farmer would indeed be able to have the exempt.
Correct. If the farmer had
Partial
purchased
exemption.
the building,
Pardon?
if the farmer had purchased the building
Right.
themselves, they
So
would.
what's
the
not in
qualified
dispute here at all is the proper use of the building for ag use.
Right.
Which again, this is where I struggle with these kind of cases because this is, to me at times, this form over substance issue, which is just, for the average taxpayer out there, for the average farmer out there who says, oh, good, I'm a farmer, they're going to give me a break. And so they go out there and they go ahead and buy a building, only to find out that the break they thought they got, they can't get, simply because they bought the building from the contractor instead of buying it from the manufacturer. And again, I know that that's the law, and I know that's why we're applying. But I tell you, as somebody who sits and tries to deal with these issues, and as somebody who then sat in the legislature who tried to understand then what the exemptions were and the purpose for those exemptions, when it came to advantages for the ag industry, I can tell you it was never our intent to make sure that somehow the building was sold and bought by the right people. The issue was you wanted to give the benefit to the the farmer in order to benefit the ag industry. That was the reason why it was all there. I'm interested in what you had said, because I want to just clarify. When you said that they asked you to resubmit the paperwork or redo something, or I'm asking you, did they ask you to do that, or did they ask you just to file the appeal?
My bookkeeper had said that they talked to somebody from the Board of Equalization, said, okay, get the paperwork straight, so the building's coming directly.
So then you restructured the sale?
At one time, we had restructured the sale. Unfortunately, my secretary that did that is no longer with us.
Do you don't have copies of that restructured sale?
No, I don't.
Does the builder contractor have copies of that restructured sale?
No. What happened, Mr. Runner, is that when CBC tried to go back, because it had been a couple years, 2 or 3 years.
CBC is the manufacturer.
They're the manufacturers, and they're the ones that would have to change the paperwork.
Gotcha.
So what they would have to do is go back and rewrite the contract to Martello Farms or Grower Direct, and they weren't allowed to do that. They couldn't go back in time and say,
okay,
we made a mistake. We need to change the name on this contract to.
That's what I'm trying to get to, if there's actually a restructured sale in the process there, but there wasn't one.
No, they weren't allowed to do that.
May I add, at
yes.
The previous hearing that we went to, this was a couple of years ago, I should say that one of the remarks made was by one of your representatives, so Mr. Martello, sometimes mistakes are just expensive, and that's...
It made you feel better?
Yeah, right. Anyway, I just should say they could use a little more tact maybe sometimes, right? So.
Okay, thank you.
Member Harkey.
Hi, I understand this the same way that Mr. Runner does. Problem is, it's very complex, and I know that my staff was working with you diligently to try to find a contract or something else. We were unable to find it, but I do agree with Mr. Runner that the intent of the legislation is to give the credit, not to find a way to not give it. I'm not blaming the department for what they've done, but I'm just saying that this seems like it's pretty simple, that whoever the building went to the entity that's supposed to go to. What happened was the construction, was paid for, or the CBC building, instead of selling to the, or instead of selling to Growers Direct, they sold to a contractor who then sold to Growers Direct nut. So it's kind of, Growers Direct was the qualified purchaser and should have been the qualified purchaser. The contractor was not a qualified purchaser. But for something that's this, do you do this all the time, or is this a one-off deal?
No, we've been building buildings since then.
Have you used the proper format
Yes,
for
we
your
have.
credit?
Yeah, since then, of course. Yeah.
Since then, yeah. But what about prior to? Had you?
You know what? This was 5 years ago, so I cannot recall
It was
whether I
a
had
long
or
time
not.
ago. It was a long time
Yeah.
ago. I understand that there are 3 causes here. They must be a qualified person, that's the first no. Property must qualify as farm equipment, machinery, and parts thereof, that's a yes. And the property must be primarily used in producing and harvesting of agricultural products, and that's a yes. So I think the intent is correct. And I just have a real hard time saying no to this. So, thank you.
Thank you.
Further discussion, members? Yeah. We had a similar situation with the solar industry some time back where the financing mechanism itself didn't allow the solar companies to receive the exemption provided to them by the legislature. And of course, everyone was sort of frustrated with that process, but the governor took it up and changed the law, and the Board of Equalization supported that. There may be some need to do that in this area as well.
To keep it simple.
Not hearing further discussion, I mean, the challenge with the specific requirements of the legislation is that to one entity, it actually provides them a tax benefit to the payment of the tax. They're able to offset that on their tax returns. They're able to adjust that in deduction. And when they're in a for-profit perspective, it's actually a good thing that the manufacturer paid the tax, because he's got to collect the taxes and so forth. He's got to offset it against his income. So there's a economic tax benefit that was incurred. And unfortunately, we weren't in a position time-wise to unwind that benefit to one in order to transfer it to the other. Inherently, when the state gives away a tax benefit, the philosophy is that it creates some type of tax benefit to the state of California. Without further discussion, members, is there a motion? Member Stoll, I move to take this matter into submission. Second by Member Ma. Without objection, members, such will be the order. Thank you very much for appearing before us. The board will take your matter into submission later on this evening and send you a written report of our decision.
Thank you.
Ms. Richmond?
Our next matter is item F, public hearings. Item F1, 2016 timber yield tax rate.
Okay, I would ask that Ken Durham come forward. Mr. Ken Thompson, I would ask that he come forward as well. Brad Heller, if they're in the room, not to have a seat, but certainly to be available. Please introduce yourself for the record, sir.
Okay, thank you. Good afternoon, Mr. Chairman and members of the board. I'm Mark Durham with the Research and Stats section. The issue before you today is the adoption of the timber deal tax rate for 2016. The annual adjustment of this rate is based on the change in the average rate of general property taxation in the 17 rate-adjusted counties between the current tax year and the preceding tax year. This year, as has been the case for a number of years, the computation results in no adjustment of the rate. Therefore, we recommend that the board adopt the rate for the 2016 timber yield tax of 2.9%.
Member Ronamos adopt staff recommendation, second by Member Harkey. Without objection, members, such will be the order. Thank you.
Great, thank you.
Ms. Richmond?
Our next matter is item F2, timber harvest values and modified harvest values.
Welcome to the board. Please introduce yourself for the record.
Good afternoon, Chairman Horton and members of the board. My name is Mike Harris. I'm a manager in the State Assessed Properties Division. And to my left is Mike Deutsch, Senior Forest Property Appraiser with the Timber Tax Program.
Welcome. Thank you.
Thank you. We're before you today to ask for your consideration and approval of the timber harvest schedules for timber harvested between January 1st and June 30th, 2016. In addition, we also ask for your consideration and approval of the modified harvest value schedules for timber killed or damaged by fire during the 2013, 2014, and 2015 fire seasons and harvested in the fourth quarter of 2015 and first quarter of 2016 in timber value areas 4, 5, 6, 7, and 8. The suggested values were developed by board staff in consultation with the Timber Advisory Committee. Thank you.
Thank you. Discussion, members. Hearing none, Member Ma moves to adopt staff recommendation. Second by Member Stovall. Without objection, members, such will be the order. Thank you very much.
Thank you.
Ms. Richmond.
Our next matter is item F3, proposed amendments to diesel fuel tax regulation 1432, other non-taxable uses of diesel fuel in a motor vehicle.
Welcome to the board. Please introduce yourself for the record.
Good afternoon, Chairman Horton and members of the board. I'm Kevin Smith. With me today is Bradley Heller. We are from the board's legal department. We are here today to ask you to vote to adopt the proposed amendments to diesel fuel tax regulation 1432, other non-taxable uses of diesel fuel in a motor vehicle. The changes, among other things, define the term auxiliary equipment and provide safe harbor percentages that can be used beginning April 1st, 2016, when claiming a refund for diesel fuel used to power auxiliary equipment. Thank you.
Thank you very much. Discussion, members. Hearing none, Member Runner moves to adopt staff recommendation. Second by Member Ma. Without objection, members, such will be the order. Ms. Richmond.
Our next matter is item F4, proposed amendments to rules for tax appeals regulations 5218, review of the petition by the assigned section, 5235, action on the claim for refund, 5237, board approval required for refunds over $100,000, and 5267, issuance of post-appeals conference notices, and this is for board approval.
Members, we might remember that this was pursuant to the request of the members. Right. Mr. Heller, please introduce yourself for the record.
Thank you. Good afternoon, Chairman Horton and members of the board. I'm Bradley Heller from the board's legal department, and I'm here to ask the board to vote to adopt the proposed amendments to regulations 5218, 5235, 5237, and 5267. The proposed amendments make the regulations consistent with the board's prior delegation of authority to staff to refund, credit, or cancel amounts in excess of $100,000 without the board's approval.
Thank you. Discussion, members. Member Stowar moves adoption of staff recommendations. Second by Member Harkey. Without objection, members, such will be the order. Ms. Richmond.
Our next matter is item G, tax program non-appearance matters consent. Item G1, legal appeals matters. These items may be taken in one vote.
Thank you, members. Any noted non-participation, members? Hearing none, is there a motion?
So moved.
Member Harkey moves to adopt staff recommendation on items G1, 6 through 14. Second by Member Ma. Without objection, members, such will be the order. Ms. Richmond.
Our next matter is item G2, franchise and income tax matters consent. These items may be taken in one vote. Sub-item 3 has been previously pulled.
Noting sub-item number 3 is pulled. Discussion, members. Is there a pursuant motion? Moved by Member Stowell to adopt staff recommendation. Second by Member Runner. Without objection, members, such will be the order.
Our next matter is item G4, sales and use taxes matters. These items may be taken in one vote.
Any non-participation, members? Noting none, is there a motion? Moved by Member Stowell, second by Member Harkey. Without objection, members, such will be the order. Moved by Member Stowell to adopt staff recommendation, second by Member Harkey. Without objection, members, such will be the order. My apologies.
Our next matter is item G5, sales and use taxes matters, credits, cancellations, and refunds. These items may be taken in one vote.
Any noted non-participation items? Would you like to pull any of these items? Hearing none.
Staff recommendation.
Member Harkey moves to adopt staff recommendation, second by Member Stovall. Without objection, members, such will be the order.
Our next matter is item G7, special taxes matters, credits, cancellations, and refunds. There are 2 items.
Members, let's,
Move to approve staff recommendation.
Second.
Member Harkey moves to adopt staff recommendation, second by Member Stovall. Without objection, members, such will be the order. Ms. Richmond?
Our next matter is item H, tax program non-appearance matters adjudicatory. Item H2, franchise and income tax matters. There's only 1 sub-item.
Mr. Ambrosia will introduce the case to get it on the record.
Good afternoon. Lou Ambrose for the Appeals Division. Before the board today is a motion to rescind the prior vote in the appeal of Robert Lowe and Cheryl Burkhoff. As a result, the board's discussion should be limited to considering whether the prior vote should be rescinded and should not include a new vote on the merits of the appeal or a full discussion of the merits of any adjustment or issue. At this time, the additional materials submitted to the board yesterday by the Franchise Tax Board do not constitute part of the evidentiary record on appeal and may be considered only for the purpose of evaluating whether the materials support reopening the matter for further consideration. In the event the motion to rescind passes, the legal department recommends that the board consider a motion to continue the hearing so that the evidentiary record can be reopened and request that the board provide staff with any direction on any areas for which additional briefing or evidence is desired. At that time, the information submitted yesterday could become part of the appeal record, and any additional evidence or information could be requested, distributed, and made part of the evidentiary record on appeal.
Thank you. Thank you. Member Ma.
Thank you, members. This matter was heard on November 17th, 2015, and it was my intention, and I believe the intention of the majority of the board, to disallow the $1,358,792 in capitalized mortgage interest from the Lowe's reported basis of $13,526,000, but otherwise accept the return as filed. Therefore, the adjusted basis should be $12,167,208. However, the minutes reflected that the board adopted an adjusted basis in the property of $11,368,562, which is not what I intended and what I understood the motion was that we were voting on. Therefore, I move to rescind the motion and reschedule the revote for a subsequent meeting. I request the revote to be rescheduled for the February Culver City meeting, since the taxpayers are located in Southern California. Therefore, if they wish to comment at the hearing, as is their right, it would be more convenient if the matter was scheduled in Culver City.
Motion by Member Ma as articulated, second by Member Runner. Discussion, Member Runner.
Yeah, just again, to review how this will kind of come back to us. This will come back to us on an H calendar?
Well,
I say, here's my question.
Right.
I asked that because one of the things that Member Ma mentioned was that the point is that there could be up for discussion, or I'm not sure you said discussion, but that the taxpayer will be able to address the issue. But I'm concerned that that's in a very limited way if it comes up on an H calendar.
well, if it is on the H calendar, of course, it's non-appearance. The taxpayer would have an opportunity to make public comment.
Right.
But that isn't technically part of the.
Right.
So how would this, how would this come back, could this come back to us so that we could have a fuller discussion, I guess, would be the best.
You might consider continuing the hearing, and then if...
But didn't we close the hearing?
Well, that vote was rescinded, right? If the vote passes to rescind, then that
And we
hearing-
can vote to continue.
Yeah.
Oh. When we took it under submission, that's not closing the hearing.
Well, you would be rescinding the vote, so you could continue the hearing if the vote to rescind passes.
So let me ask, okay, hold on, let me just see if I got this clear. Normally, when we take something up for at the end of the meeting, the assumption is that we have closed the public hearing. And then we vote. The only thing that we are rescinding is the vote that was done at the end of the meeting. So I'm a little, I just want to make sure we have that correct. Because I always thought that once we closed the public hearing discussion and we moved it to a vote, that the public hearing was then closed.
No, I believe you could have continued the hearing during the vote.
We
for
could?
example, Yeah.
Okay,
And
okay, that's good. I
you know,
get that, okay.
There are 30-30-30 motions as well
That we continue the hearing at that time, okay.
Correct.
Good, okay, I understand that. Then I think the assumption would be that this would come back back to us then on a B calendar. Correct?
If that's how the board would rule, yes.
Is that I'm just concerned about how it is it comes back to us so that we're able to talk about it and the taxpayer is able to talk about it. But I'm willing to respond back to Member Maud at what her intention is.
Here comes
Mr. Ferris.
counsel.
Yes.
Yeah, to the extent any member believes that there may be additional information or argument that may be helpful to the board in its deliberations with respect to future motions that the board might make, we are recommending that the board vote to continue the hearing so that the board can receive this additional evidence and argument and be able to discuss it fully and be able to ask any questions of both parties that would be relevant to their deliberations.
So is our motion then to rescind and then continue
First, you
the
have to
hearing?
rescind.
And then we can do a
Then
subsequent motion to
a
continue the
second
hearing?
motion would be to continue the hearing.
And then it can show up.
If anybody believes that additional evidence and/or argument may be helpful to the board with respect to any future motion.
Mr. Renner?
Right, again, I just want to make sure that all of a sudden as this comes up, that this comes up in a calendar to which there could be some discussion about it, if that's indeed what is warranted with this additional information.
Right.
If we continue the hearing, basically, it could come up, if the taxpayer is satisfied, it could come up on an H calendar, it could come up then on a B calendar, right?
Mr. Ferris?
Yeah.
Well,
Hesitate to answer.
I mean, I think that if you continue the hearing, it will
Yes.
come back on a B calendar.
Okay. Unless the taxpayer comes to an agreement.
In which case, it would come back on a G calendar.
Oh, okay.
Right, or no, it'd be adjudicatory, so
Adjudicatory.
it would be H.
Yeah,
Well, if they came to agreement, they might even not come back, but I don't know if that's going to happen.
gotcha.
You know, I mean,
That's probably a pretty good guess. Okay, I'm done. I get it.
Member Harkey?
How, and this is for legal, how is this different than if the taxpayer filed for a rehearing or, another hearing? What's that, not a continuance, but actually filed an appeal to have
Right, they filed a
rehearing?
petition, and they have until, if the motion to rescind does not carry, the taxpayer has until close of business tomorrow to file a timely petition for rehearing.
Okay, so
And
it's
they've previously
really,
been advised of that.
Right, and I'm saying it publicly right now, too, just
Again.
to reinforce that.
okay, I get nervous when things are just left dangling. This is a lot of dollars for them. What could go wrong? Because
Scheduled.
it's not that it wouldn't
it would
get
just-
scheduled, but if it came up and there was, both parties would be able to resubmit evidence, correct?
Correct. Right, and if a motion to rescind passes and if a motion to continue passes, we're also asking you to provide appeals guidance with respect to any additional evidence, information, argument that you feel would be helpful to you. And we would want to be communicating that to the parties. And since it would appear that it would be in February, there would be sufficient time for them to address that. And hopefully the board would have the complete record that it needs to consider any subsequent motions that might be different from the original motion that would have been rescinded.
Can I just ask to Member Ma, is the extent of your concern to correct get a corrected motion to what you believe the original intent of the motion was to be?
Yes,
Not necessarily have a new hearing?
correct.
Okay. So if that be the case, what would be the proper way to just get to that point?
Bring it back on the H calendar.
Right, you would just rescind and bring it back on the H calendar. We're only out of an abundance of caution are we bringing up this point, that if there is additional, if you feel the record is complete enough to make whatever subsequent motions might be contemplated, then you don't need to continue the hearing.
Okay.
But if there's any doubt that the record as it stands right now is not sufficient to support whatever motions may be made, then we would advise that you reopen the hearing so that we don't come back in February and then have to continue it again because the record is closed and some additional information is relevant and can't be put into the record to support a motion.
Member Harkey?
Let me ask you this. If we just wanted to have no additional information and just rescind and then have a revote, could we do so?
Oh, yes. Yeah.
And we wouldn't have to hear or see because I was the maker of the motion.
Correct.
And I did contemplate a little bit different, although I had all the data and I had all the spreadsheets. I had, when we got into all the conversation, I was making a motion initially for the entire, but, you know, then we got a lot of information.
Yeah,
And
so we could do that on an H
it's-
calendar, and they could make public comment in
It's-
February,
but we
but the
can't-
board couldn't take whatever they say in public comment into account with respect to
Right,
how to
right,
vote.
but what I'm saying is that I did make the initial motion, I made a secondary motion. So if we were to rehear this, we wouldn't have to be taking additional information, we could just rehear, or we could just revote.
If they don't file a petition for rehearing, which would be a whole different process.
Right.
Then if you don't continue the hearing, the record of the hearing is closed because you took it under submission and didn't give any other indication that you wanted to continue the hearing. So whatever is said in February, if that's when it comes back, will not be relevant or probative to anything you decide in February, because you will do it based on the record as it stood in November.
I just get really nervous of how it could go wrong, and so I'm just being a little extra cautious to be sure I understand it fully, what the options are here.
Right, and I think it's wise for us to have good discussion, yeah. Yeah, and just to clarify, if we move forward with the issue of rescinding, and would it then at that point simply automatically come back to the H calendar?
Correct.
Okay.
We'd have to have instruction, right?
Well, let me just, so it would come back on an H calendar, and then at that point, a new motion can be made at that time. That was maybe reflected, at least, in the nature of the motion, I don't know if it'll be like that, but like Member Mond did. At that point, then, that could conclude that particular hearing. And then if the taxpayer feels like they have additional information or issues that they want to talk about in regards to some of these other issues, then they can just simply go through the process of filing for a new hearing after that, correct?
That is correct.
Okay.
Just to clarify, if I could, maybe we ought to give the members all of our options. The rescinding of the motion basically opens the case up as if though it never happened and brings the case before us today. Today, literally, we could actually, other than having to post some time, then the members at posting the time can take the matter up. If we take it up, if we direct staff to say we want it brought back on the H calendar because we don't feel that any additional information is necessary, we've heard everything, all the facts are on the table, and we can make a decision based on the facts presented to us previously. If we feel that there is additional evidence that need to be considered, we would ask that it comes back on a B calendar so that the parties can write their briefs, provide data to the members, as if though it started all over again. And in that case, they don't have to submit any additional evidence to prove that to the department that there's basis for a rehearing, even though the board has the ultimate decision on the rehearing. And the matter before us is to rescind and open it back up, or not? Mrs. Stower?
Yes, thank you. Ms. Mom, I want to make sure I understand that you're asking to rescind because you were under the impression that the motion was going to include the 1.3 million in interest.
Yes, and I
Exclude.
want to exclude it, meaning decrease
Yeah.
the reported basis on their tax return by the 1.3,
So you,
792.
okay, so you did not think the motion included the construction costs as agreed by Mr. Zebo? Because I know that we had one motion which was withdrawn, and then Ms. Harkey made the second motion to include the 8.4 million in construction costs and other various items. So I'm not sure,
No.
you didn't think we were voting on?
No, I thought we were just,
Yeah.
we were just decreasing the basis by the
By the 1.3.
capitalized mortgage interest of 1.3.
Okay, I understand what your concern is.
Yeah.
My concern is that the fact that since we had such a great discussion about the 8.4, where Ms. Harkey even provided the detail and the schedule, and I took some time to look at it, from my perspective, I was clear on what I was voting for and concluded that Ms. Harkey had made a reasonable estimate of the cost of the property. I'm also concerned that a notice of determination was sent to the parties, and that notice was sent on November 19th, 2015, informing the parties of the board's decision. And I just have a concern to rescind something after we sent them formal notification. I see this being different than in the past when the board has voted on a case on a 2-day or a 3-day meeting and came back and expunged the vote or rescinded the vote. In those type of situations, the parties to the appeal had not been contacted officially. And since they have been contacted officially on this one, I cannot join in rescinding the motion. I think the best cause of action here is for the parties to file a petition for rehearing and to consider it at the rehearing. And even at that point, if they want to make the argument that additional basis should be allowed, they can provide the evidence or the arguments, and we could evaluate it and determine if we want to include the additional basis without granting a rehearing. We can just make this, we can agree with them then. But I think we should respect the process, especially considering that we sent out official notification.
So, can I?
Yeah, sure.
Chair, you know, we understand that there was some notice or not a notice, and if there was a notice, was it sent out before the minutes were clarified for the case? So can legal please clarify whether a notice of determination was sent to the taxpayers?
Yes, after every oral hearing, we send a notice to the parties about how the board voted. And so they received a pretty simple notice. I don't have it in front of me, but it's a couple sentences describing the board's vote. And it advises...
Is that within a day or two, right?
Within a day or two, because we want to let the parties know that the clock is ticking to file a petition for rehearing. And the notice would state that the matters will become final in 30 days if a petition for rehearing is not filed.
So is that the typical process?
Yes.
The reason...
Member Ma?
Okay.
Member Runner?
The reason why I think the rescinding is a good option is because there was a lot of confusion at the motion itself. I would agree that it would be a better way for a rehearing if there was clarity in the motion and everybody understood exactly what it was. I, for one, in that discussion, because I was trying to get to the numbers, because we kind of started doing one calculation over here, and then there was a new calculation going on, and I know I specifically asked during that, does that number the same will their liability be the same as if we went ahead and just took away the mortgage issue? And the answer at that point was yes. And so I believe at that point, that's what kind of took us down the path to not understanding exactly the outcome of the motion, which is why I think this is not necessarily a rehearing issue. It's not that the taxpayer has new information or anything. It's that we had some confusion, and is why I think it's appropriate to rescind.
There were a lot of numbers flying around.
May I comment? I respect that, but I'm just looking at the notice of determination. Based on the evidence presented on appeal, this board determined an adjusted basis for the property of $11,368,562, computed as follows. Property acquisition price, $2.8 million. Estimated construction cost, $8.4. Landscaping cost, $62,000. Related expenses and fees, $17,000. So at least the author, the writer of this letter was clear on what the motion entailed. I stand by my objection. I think we need to respect the process when an official determination has been sent to the parties.
Okay. Members, I think it's inherent upon the members as triers of fact to do whatever they need in order to make sure that they have all the facts on the table in making their decisions. It's and conceivably just part of our fiduciary responsibility to the state of California and to ourselves. What I'm hearing the members say is that all the information was on the table, and so there isn't a necessity to bring this back on a B calendar. If we were to bring it back, maybe an H calendar to change the motion. So my thoughts relative to the motion after reviewing the tape and viewing the motion and the discussion is that the motion was clear. I quite frankly, from my perspective, under the Cohen rule, all of the motions were a little bit friendly to the taxpayer, but that being what it is. But the motion was clear. The interest adjustment was reflected in the motion and appropriately reflected in the motion. My view of the motion initially is that some of the items included in the motion should not have been included in the motion by virtue that there wasn't documentation to support it. And I don't necessarily, I think probably the best way to deal with this from my perspective is to have the parties, have the taxpayer request a rehearing, and then just have it come back if that's the case, if everybody wants to hear it and everybody believes that we need to discuss this further, which accomplishes the same objective at the end of the day. But that be it. A motion on the floor with a second. Objection noted. Ms. Richmond, my apologies, Member Ma.
I have one more question. So after the hearing, when do the draft minutes go out?
They're on the agenda for today for the board's adoption.
No. The preliminary, the probo.
Oh, that's already been posted to the website.
How many days does it take to put it up?
About 3
days.
2 to 3 days.
So in this case, the letter went out the next day before the minutes were posted?
I don't recall.
I would say so, yeah. I don't specifically recall, but I'd feel 95% sure that that's how it happened.
We try to notify as soon as possible because with franchise and income tax matters, it's a strict 30-day window for them to petition for rehearing. There's more time in business taxes. It's usually 45 to 60 days before something becomes final. So with franchise and income tax, we try to get those letters out.
Yeah, and we actually work with board proceeding staff on the minutes, to make sure the minutes are correct as we understood them. And I know sometimes a discussion evolves, and here it appears there was a misunderstanding, but that's our standard procedure.
So shouldn't the letter go out after the minutes are approved?
Probably not. No.
What does the rule of tax appeals say?
Actually, that's a good point. The rule of tax appeals gives, I believe, 3 business days for the letter to go out. I could look at it. So it's a pretty strict timing deadline.
To the member Ma, with your permission, sending this letter does not prohibit the board if the board is of a mind that there is factual evidence that or some consideration that should be taking place. It is not a condition upon which we can make a decision. We can, of course, we can say anything we want to say up here, unfortunately. But as far as the appeals rules and so forth, that's not one of the issues. Now, if there was a technical error of some sort where the motion wasn't clear or the intent to take something up that we didn't take up that was kind of codified or included in something, that's the technicality. This is a point where the motion was clear, the interpretation, and I don't want to read into it, but the understanding of the motion wasn't necessarily clear, and therefore a need for further clarification or modification to the motion is what I'm hearing is the position of Member Ma. So there's a motion on the table, a second. Ms. Richmond, please call. And let me just say for the record, when it comes to those technical reasons, I generally say good with it. I think it's appropriate. Ms. Richmond, please call the roll.
The motion to rescind.
There's a potential for two motions. We will take them up separately, members. First motion before us is a motion to rescind. The second by Member Runner. Objection noted. Ms. Richmond, please call the roll.
Mr. Horton?
No.
Ms. Harkey?
Aye.
Mr. Runner?
Aye.
Ms. Ma?
Aye.
Ms. Towers?
No.
Motion carries.
Now, members, the motion before us, the option before us is to bring it back on the B calendar, have the facts, additional facts brought forth. The other facts can be rediscussed. In fact, bringing it back on the B calendar basically allows us to do the case all over again if we want. We can bring all of the facts back, which would probably be the case. I would imagine that the parties would want to sort of adjudicate this all over again to make sure that their points were clear. That's a B. On an H calendar, it comes back on the H calendar. The parties have an option to come and say whatever they want to say. The board can't take that under consideration in our vote, and we just vote based on the previous record under the H calendar. Is there a motion?
I'm satisfied with just the revote, and then that enables then, if the taxpayer wants to go appeal, wants to file for rehearing at that point, they can, so.
Member Runner moves to bring the matter back on the H calendar in the month of February, second by Member Ma. Objection noted. Ms. Richmond, please call the roll.
Mr. Horton?
No.
Ms. Harkey?
Aye.
Mr. Runner?
Aye.
Ms. Ma?
Aye.
Ms. Towers?
No.
Motion carries.
Thank you. We survived. All right, Ms. Richmond?
I'm nervous about this.
Our next matter is item H4, sales and use taxes matters. There's only one item.
Members, just for the record, staff has submitted a partial denial of the interest. I'm presuming that all officers remain aware. Is there a motion to adopt staff recommendation given the partial denial of interest, relief,
So moved.
or otherwise? Moved by Member Harkey, second by Member Ma. Without objection, members, such will be the order. Ms. Richmond?
Our next matter is the administrative session. Item N, consent agenda. We have N1, a retirement resolution for Susie Leon. The members of the board wish to extend their sincere and grateful appreciation to the retiree for her dedicated service to the State Board of Equalization and to the state of California. Their congratulations on her well-earned retirement and best wishes to her and her family for continued success, happiness, and good health in the years to come.
Congratulations to Miss Susan Leon. She was a trainer in the Culver City District and a recruiter as well. Did an exceptional job over the years as an auditor. I chuckle because she actually had a retirement celebration, and a lot of folks went to the retirement celebration. Then she went back and recalculated and figured the retirement date was too soon and pushed it back a little bit. So I only share that to encourage all of us that are contemplating retirement, make sure we get the date right. Ms. Richmond, the other items?
We also have item N2, approval of board meeting minutes for October 27, 2015, October 28, 2015, November 17, 18, 2015.
Noting that the board just amended the minutes of November through that rescission vote, so whatever motions you make should take that into account.
Okay. Member Ma.
Okay, now I have another question. This is December, and we're voting to approve the minutes of October and November.
Yes.
You want?
Yet we send out letters before the draft minutes come out. Yet we officially vote to, I mean, and that's why we caught the motion, and my request to rescind is because after the minutes came out is when there was a lot of confusion on what was written and what was oral. We had to watch the tapes again. So I'm just asking that is this the time that we are officially approving the minutes?
Yes,
For October and November?
that is correct.
And
Before
so-
that, everything is just a draft and is subject to revision and input from staff and members' offices to make sure that everyone is comfortable that the minutes are accurate and properly reflect what happened in the meeting. And then once all that vetting has happened, and it takes some time to do that, it comes officially onto the agenda like it is now.
Okay, so I'm just trying to avoid what happened last time.
That's a rare occurrence.
Well,
Do we get the staff, did we get copies of the draft minutes?
Yes, they're
To
sent to
approve?
each office.
Did each office approve it, like verbally or in writing?
In writing,
To the clerk? Each office did?
yes.
So, did my office do that?
Yeah, you don't have your office. Yeah, they do. They approve.
they're
Within-
nodding yes.
Within 3 days? Okay. All right. I'm just kind of confused because we approved the minutes so far.
And you're thinking, I think,
After.
of the preliminary record of board action, which is posted immediately following the meeting,
Yes.
which is different than these
Than the-
minutes.
Than the draft minutes. So, okay, so after this meeting, what do you post? You post the preliminary,
Correct.
and then you send out draft minutes
Yes.
within 3 days?
No. Those take a little longer.
Because sometimes I have to consult the video record of the hearing. It's much more detailed than the preliminary record is.
But then the letters to the taxpayer goes out within a day or two?
That's statutory.
Correct, yeah. And staff does listen to the motions very carefully in drafting those letters as well. And I think that that Grant was, Mr. Thompson was representing, that they did listen carefully and put into the letter what was said in the literal language of the motion.
Possibly you can share the reason that's the case in the rules of appeals?
Right. So especially with franchise and income tax matters, it's a different rule on finality than it is for business taxes. But by statute, the board's action becomes final within 30 days of the motion carrying. And so it's really important to give the franchise and income tax appellants and franchise tax board the opportunity to have a full 30 days to understand what the motion was and to prepare whether or not they want to file a petition for rehearing. So we don't want to cheat them on that very limited 30-day window that they have. So by regulation, we're obligated to get that information to them in a very timely fashion.
Another wrinkle to that is that was actually a Section 40 case. So even after we go through all of that, it still isn't final until the Section 40 comes back.
No, the default rule is that it's a summary decision.
Summary decision.
And therefore, it would become final it will become final, well, now it won't because the board rescinded its vote. But
Right.
if the board hadn't rescinded, it would have become final tomorrow, even though it is a Section 40 opinion.
Okay. So there's a motion. There's a motion on the table to adopt the consent calendar, noting the modification to the rescinding of the vote pursuant to the Rob Lowe case, and encouraging that the minutes so reflect such, and giving the board an option to bring those minutes back if in fact that is not the case. Is that sufficient motion?
Sounds good to me.
There was
I'll
no
second.
motion, sir.
No, I'm asking for it. I'm
He's
just,
making-
I'm
he's
just
making-
So moved.
sort of defining it, sort of to make it easier.
Unless you're moving it.
Moved by Member Harkey, second by Member Maher. Without objection, members, such will be the order.
And that's for items N1, N2, N3, and also N4.
N1, N2, N3, N5.
All those in.
We will
And N4.
take up separately.
N5.
N5, all of them, yeah, why not? Ms. Richmond, oh, unless there's objection. Anybody want to look at N5? No, don't hear it. All right. Ms. Richmond.
Our next matter is item P, other administrative matters. Item P1 is the Executive Director's report. P11 is the State Controller's Office findings detailed in its review report, internal accounting and administrative controls review. And I believe we have a PowerPoint.
Yes. Thank you.
Welcome to the board. Please introduce yourself for the record.
Good afternoon, Chairman Horton and members. I want to express my appreciation to the board for your...
Ms. Bridges, please introduce yourself. for the
Cynthia
record.
Bridges, Executive Director.
Julia Findley, Acting Chief, Financial Management Division.
And Edna Murphy, Deputy Director of Administration.
Again, good afternoon, honorable members. I would like to express my appreciation to the board for your engagement and solutions to the findings cited in the State Controller's Review Report relative to BOE's internal accounting and administrative controls. For your edification today, the financial management team and I wish to provide you with an overview on the history of the issues and initial going forward plans in response to the referenced SEO review report. As you know, the Chief of SEO's Audit Division recommended that BOE develop and submit a detailed corrective action plan within 6 months to address each concern identified, particularly internal controls over the retail sales tax fund's revenue allocation process and the office revolving fund. As referenced in my November 30th memorandum to you on this matter, a preliminary corrective action plan and other recommendations will be provided to you in January 2016. The most significant concern in the SEO report is BOE's allocation of retail sales taxes among several state and local funds. Let me reiterate, and it was also confirmed by the SEO staff, that it does not subject the state to financial exposure as it relates to distributions to the locals, counties, and special taxing jurisdictions. The SEO findings were consistent with what the BOE had already identified as a result of a previous fund reallocation adjustment. When I was first informed of the potential of a revenue allocation issue, I immediately ordered an internal review to determine the nature and extent of the issue. Staff subsequently commenced actions to prepare recommendations to reduce the recurrence of the issue. Additionally, given the extent of the allocation issue and my professional judgment that other reporting challenges existed regarding BOE's financial management operations, I commissioned an external study for recommendations to update and reform the BOE's financial management operations. The Revenue Cycle Management Analysis Report, which was forwarded to you in October, concluded that a number of reforms were required to improve the accuracy, efficiency, and integrity of the BOE's accounting and reporting functions. Both the internal review and RCMA report reference the following systemic and institutional deficiencies as requiring attention: a tax administration system, the Integrated Revenue Information System, commonly referred to as IRIS within the agency, lacks revenue accounting functionality, is cumbersome to update for tax changes due to its now outdated platform and the voluminous modifications that have occurred since its inception 25 years ago. An outdated external accounting system and extensive manual accounting processes, facilitating a greater risk of errors in accounting transactions and reports. The BOE's final management structures, as they currently exist, reflect silos rather than a best practices, fully integrated revenue accounting and reporting operation. That this systemic siloing is rooted in an institutional culture that worked well before the rise of multiple local government taxing jurisdictions, as well as the increasing complexity of state-imposed revenue programs, but now stifles effective communications internally and externally and impacts the accuracy of revenue fund allocations. We're happy to share that BOE is moving forward in preparing an initial allocation adjustment based on the current internal and SEO findings. The BOE will be collaborating with the Department of Finance and SEO regarding the proposed adjustment and underlying methodology. We will apprise members on the outcome of the work with DOF and SEO prior to any execution of an adjusting entry. Internal audit staff is engaging with Financial Management Division management in a consulting capacity regarding accounting process changes, and more importantly, the internal control requirements as provided in Government Code Sections 13400 through 13407, known as the State Leadership Accountability Act. Additionally, to supplement the RCMA report, which due to time constraints was not as detailed as I would have liked, the Revenue Management Team is in the process of developing the scope for the procurement of an external consultant to assess the BOE's revenue recognition and implementation activities, as well as accounting and reporting advisory services, which should include transformation solutions. The proposed scope will be submitted to members via the 3-day review process prior to initiation of an RFP. I am encouraged by the board's proactive participation, working together with staff to bring about financial management reforms. Again, pursuant to the members' request for an review relative to the history of the issues cited in the SEO review report and a go-forward plan, Acting Financial Management Division Chief Julia Finley will address in more detail the retail sales tax fund allocations, pending reallocation adjustments, and internal corrections that have been accomplished and soon to be undertaken. Deputy Director of Administration Edna Murphy will follow her with an overview of the office revolving fund improvements and proposed next steps. Ms. Finley.
Good afternoon. I'm Julia Findley, Acting Chief Financial Management Division. Please refer to the slide that provides a brief history of the BOE's endeavors to review the revenue process. The Local Revenue 2011 component of sales and use tax went into effect July 1st, 2011. In September 2011, the State's Controller's Office established the Local Revenue 2011 Fund. In response, the BOE initiated a $342.9 million adjustment to transfer the Local Revenue 2011 taxes collected in the General Fund into the newly created fund. In August 2014, the BOE initiated an adjustment resulting from an internal review of sales and use tax fund allocations in response to issues raised about potential underfunding of the Public Safety Fund. In December 2014, the BOE established a work group dubbed the Revenue Allocation Team, made up of units involved in sales and use tax revenue allocation and distribution, to determine if issues identified by the internal review were corrected. The team consists of Research and Statistics, Local Revenue Allocation Unit, Technology Services Division, and Accounting. In January 2015, the BOE contracted with CPS Consulting to evaluate the revenue accounting process. In March 2015, the Revenue Allocation Team prepared an informal issue paper that discussed allocation issues, including the need for a cross-unit communications and training for accounting staff. In June, the team proposed a simplified process for reconciling the quarterly revenue allocation reported by taxpayers to daily factor-funded remittance advices. The BOE delayed implementing fund allocation adjustments to ensure all issues were identified and to await any additional items that may be noted through the revenue cycle management analysis. In July 2015, the BOE provided a corrected template to the DMV that properly allocated the funds and began discussions with DMV on an electronic solution. As indicated by the previous slides, for the past several months, the Revenue Allocation Team evaluated the sales and use tax fund allocation process, which included a comprehensive review of reports used to reconcile daily remittances to information system reports. The simplified process discussed previously excludes suspense, DMV, and FTB from the reconciliation of reported allocation to daily remittances and correctly allocates the additional sales tax on diesel fuel to the general fund. Prior to the implementation of the revised allocation template to DMV, the Financial Management initiated an adjustment to correct DMV fund allocations for the period of October 2014 through April 2015. The Revenue Allocation Team submitted a request to Technology Services to modify reports used in the revenue allocation process and is continuing to evaluate additional reports that may be useful for more frequent reconciliations and monitoring. During the review process, the team automated IRIS reports used in quarterly reconciliations that were previously provided in paper format to improve efficiencies and reduce the risk of error. next slide. Going forward, the BOE will complete its review of fund allocations in December 2015 and collaborate with the Department of Finance on proposed adjustments in early 2016. The adjustments identified by the revenue allocation team included corrected allocations for DMV, FTB, and diesel fuel consistent with the SCO's findings. The SG component referenced in the SCO report is actually the claimed fuel tax credits which come from the Schedule G and are allocated in IRS reports. However, any unclaimed fuel tax credits are allocated based on factor funding until they are claimed. The revenue team is working with Technology Services to develop a report to capture those unclaimed credits. The proposed adjustment is substantiated by documentation and is subject to third-party verification. The Financial Management Division reached out to Program to obtain training materials on legislative mandates and to begin training accounting staff. The accounting branch partnered with Data Analysis Section and Technology Services to address accounts receivables reporting to incorporate SCO-approved write-offs. In addition, the accounting branch is evaluating and documenting processes to ensure compliance with accounting and governmental standards and to position itself for CROS and Fiscal. The evaluation includes updating policies and procedures, performing risk assessments, and developing appropriate controls to mitigate risk. Last, we will engage internal audit to evaluate the processes to ensure compliance with standards and to validate the related controls and monitoring put in place to mitigate risk. That concludes my portion of the presentation.
Good afternoon, members. Edna Murphy, Deputy Director of Administration. In response to BOE's preliminary internal audit, which was released in August of 2015, the Financial Management Division implemented procedures related to the revolving fund, which noted many of the same issues that were identified in the SCO audit. In both audits, one important area noted was the need to identify tracking and monitoring tools to ensure that process and procedures that are in place are being adhered to. Both reports had a review period of July 2013 through February 2015 for our internal audit and April 2015 for SCO. In July of 2014, the Financial Management Division updated the policy reminding employees of timelines to clear travel advances and the consequences of fundings being taken from their payroll warrant when not done. This policy was also reissued to all employees again on October 2015. In November of 2014, the Financial Management Division released its updated travel guide, which is posted to our intranet. We also implemented procedures that encompass secondary approval for travel advances, and we established processes to ensure that documentation is maintained, that is accurate, and properly filed. In addition, we developed processes with the Human Resources Division to ensure a prompt collection of employee account receivables, which includes the timely submission of collection letters. And then finally, we developed procedures to weekly process claim schedules to replenish our revolving fund. Some of our next steps: we continue to train managers, supervisors, and BOE employees on salary and travel advance policies and procedures. This may include Take 5 videos, town hall meetings and training, frequently asked questions, and the distribution of monthly travel tips. We're currently working on the development of reports and tracking system for our travel and our salary advances. We're going to engage our internal audit staff to evaluate the process changes and the monitoring controls to ensure sufficient risk management, and we plan to implement quality assurance programs to ensure compliance with the state and BOE policies. This is the end of our informational update, and we'd be happy to answer any questions that you may have.
Thank you. Discussion, members, Member Runner.
Just a couple of quick things. I'm glad to hear that the efforts being moved forward in regards to the outside third party RFP.
Yes.
Because I know that wasn't real clear when we had met and contemplated some other issues, so I'm glad to hear that that's been added to it. Tell me about the timeline for that.
We will be forwarding in January, if not before then, a recommended scope with regard to the services that we're securing. At a minimum, it should contain or include an evaluation of data management, data validation and reconciliation, analytics, automating annual processes and reporting, governance, and internal controls as part of the accounting and reporting assessment to a certain extent. So we will provide the scope for the members' review and shortly thereafter embark upon the the RFP process. And I would ask Ms. Murphy to address the timeline with respect to general contract procurement processes.
So I think portion of it will just really depend on the scope. We do have some current contracts already that we can tap into with CPS if it's coming in to do some additional training, which was one of the things that was identified in the Revenue Collection Management Audit. I'm trying to remember the RMCA. So if it's for some of the training, we'll be able to tap into that. For the scope of coming in to do the validation, kind of the review of the process, et cetera, so on, we will probably have to go out through the procurement process and take that to bid.
And I'm envisioning that for the services that we're looking for, it will more than likely include us going out for bid for that.
Because it's over.
I think that for the level of assessment, the amount of assessment that we're asking for and the time that it's going to take and the amount of effort engaged in performing those services, it is going to take quite a bit of time and effort. And of course, I'm also looking at the expertise that we're looking for from the consultants that will be actually conducting the assessment.
So again, where do you, so some like timeline dates?
We can provide that along with the information relative to the scope.
And okay, and so as the scope gets developed, then you'll know the length of time that the
right, and that will
contract
also be
will run.
incorporated into the preliminary action plan that we're also submit in January as well.
Okay, let me ask you then specifically too, in regards to the fund reallocation adjustment. Right now, at least if I'm understanding this, the target is to do that by December 31st.
I think the target is to at least complete the determination based on the information that was already provided in the SCO report. They had already made some determinations. Staff has actually reviewed and validated those calculations as well. But generally, the practice is when we make those kinds of adjustments, we work in concert with the Department of Finance as well as SEO because they have an interest in actually reviewing it, understanding the methodology, and basically approving it before we actually execute those adjustments. And I am going to, again, refer to Ms. Murphy since she has had some experience with that in the last reallocation adjustment that was done. If you have anything else to add.
Well, like she said, we worked very closely when we did the allocation last year in 2014 with Department of Finance. One of the process that we do on a regular basis is we do quarterly true-ups all the time. So we do these adjustments. They're very familiar with that. But as we're doing something, when we're taking consideration that some of this information goes back over several years, we want to make sure that we're working collaboratively with our stakeholders and that everybody is in agreement to the changes that we're going to be putting forward.
So even though we want to basically complete our analysis and review of those issues that were cited in the SEO report with correcting those particular allocation issues, it doesn't necessarily mean that we're going to be actually making the adjustment until we have actually had the reviews and discussions with the control agencies. And then, of course, upon their recommendation, we will make the adjustment, and it could be in January, it could be in April. It's going to be dependent upon whatever their workload is. Obviously, they're going to be very busy with the budget in January, so we're not sure whether or not that would be an appropriate time frame to execute the adjusting entry.
Okay, thank you.
Member Stowa.
Just real quick, thank you. Make sure I understand, you said you are going to be contacting an external consultant, and you're indicating that the scope will be shared with the members in January.
Yes.
Okay. I also would encourage you to contact the SEO audit team.
Okay.
Management there. They're open and willing to work with everyone here at the BOE
Okay.
in resolving some of the problems. 3-day review seems to be a bit short for me, so I would ask for more time to look at it. So as you're developing the scope, if you can send it to me on a flow basis, and probably the other members would be great, so that we have a good idea of what you're developing day by day.
Okay.
That's it for right now.
Member Ma? No? Okay. Thank you. The board will receive and file. Thank you very much for your presentation. Hearing no further discussion by the members. Ms. Richard, what's our next matter?
Thank you.
Our next matter is item P12, the Strategic Management Plan for 2015-2020. And we also have a PowerPoint.
Welcome, Mr. Gao. For the audience, let me just share with the audience that the members have a visual in front of us so we can see the PowerPoint. It's not that I didn't want to show you my bald spot.
Good afternoon, Chairman and members. David Gao, Chief Deputy Director. I just want to take a few minutes at the end of your day today to highlight the agency's new 2015 to 2020 Strategic Management Plan. The Strategic Management Plan conveys the agency's goals and the actions needed to achieve those goals in the face of some really rapidly changing circumstances. It relies upon identification and tracking of emerging and existing issues and formulation of appropriate innovative strategies for resolving those issues. Really, basically, the strategic management provides the common framework for which we operate. What we do as an agency should really be consistent with and point back to our strategic management plan. The previous strategic plan covered the years 2010 to 2015, and we actually have just highlight a few things from that prior report that we accomplished. One, we expanded our services to include online registration and installment payment agreements. We launched the BOE's Open Data Portal, created a new geospatial information tax lookup tool, and debuted industry and tax guide web pages. So over the last several months, we've worked through a process to update the strategic management plan that will cover the years 2015 to 20. We also surveyed staff and held some focus group meetings with staff and solicited input from external stakeholders as well. So the mission statement, it did not change, nor did we feel it should. It's the mission of the Board of Equalization is to serve the public through fair, effective, and efficient tax administration. However, in order to position the agency for the 21st century, we did modify our vision statement to read now, a Board of Equalization where together people and technology achieve the mission of the agency and deliver superior customer service through transformed business processes and organizational structure. The updated vision statement spells out the future direction of the organization and where we see ourselves long term. Our core values have been updated to state, we put people first. We will focus on our customers' needs and exceeding their expectations. We will support and respect each other to achieve the board's goals. We are committed to excellence. The integrity we exhibit will establish trust in the customers we serve and amongst ourselves. And we are dedicated to improve the quality of our products and services. And then lastly, we keep getting better. We are devoted to constant innovation and are lifelong learners. 3 simply stated goals: maximize voluntary compliance, enhance operational effectiveness, invest in the organization. These remain relatively the same. However, our objectives to achieve those goals have been updated to meet emerging trends and evolving customer expectations. Implementing these goals and objectives as an organization will drive the BOE to think and act more organizationally. So the strategic management plan is our roadmap to the future. So that concludes my report on our strategic management plan.
Discussion, members? Hearing Member Stover.
Thank you. Just one quick question. How are these goals communicated to staff, and how do they embrace them?
Okay. This is one of our first efforts here is through this presentation to you and the boards, which we will obviously be sharing with staff. We also have developed a real short version of the plan that we will be disseminating to them, asking our executive team to message and also throughout the organizational chain to make sure that people understand our goals. We'll also be working on a high-level business plan to how are we strategically going to implement this, and what are the projects and efforts we're going to be working on, and we'll be developing that as a team effort.
Thank you.
Thank you, Mr. Gao. I just wanted to share what I think everyone knows, but a subset to the goals as we begin to sort of develop those is to continue the outreach and education of our taxpayers. We also often, not us, but the public often loses, some members of the public often lose sight of the fact that we have a 98% compliance rate in the state of California, and that is inherently possible, and because of the education, because of the outreach, because of the customer service, those are the elements. The audit department in and of itself does not necessarily generate the revenue, but it does generate compliance, and I think that's key. The other component, as a subset to all of that, is our employees. One of my objectives, and would encourage to be our objectives as a board in the coming year, is to ensure that the high level of competence exhibit here at the Board of Equalization has parity as it relates to compensation, and that we're able to articulate that to the legislature and to the governor, which I believe has somewhat of a different perception of the Board of Equalization, doesn't necessarily see it as a revenue-generating agency, wherein for every dollar invested in the Board of Equalization, $100 plus is in return. If I was to tell anyone else that story, they would gladly allow us to expand and create promotional opportunities and provide compensation, at least in parity with everyone else, because we are performing consistent to what every other agency. In fact, in many ways, we are superior in our performance, our objective, and our productivity. Thank you.
Thank you.
Member Ma.
Thank you, Mr. Gao. Can you just talk about the surveys that were sent out? How many surveys were returned and kind of the responses? I think that was an interesting statistic.
Yeah, we had nearly 40% of our agency's staff, and it was a very high percentage of field staff that responded to the survey. So I think it truly, and the people that helped us perform the survey indicated that is a very positive response rate for a survey of this nature. And to us, it was indicative of the involvement and concern of our employees, that they really care about this agency and what they see, and they want to have their opinion heard as far as where we are going in the future and what they see those are, what issues they are. So that input, it was critical into the process that we use to establish the goals and the objectives that we are.
So were all the employees surveyed or sent an email?
Yes, they were.
Numerous emails?
Correct.
opportunity to respond? They were anonymous, or?
They were anonymous, and we sent it out, I believe, twice. We sent it once, and then I believe we sent a reminder, if my recollection is correct, to get that input from them.
And so their input is that going to be used in which part of?
Yes, it
strategic
was.
management plan?
It was used in actually putting the whole plan together. What I didn't get into, and I would be happy to, is beyond the goals, we've set some objectives, and I think the chairman was talking about some of those that are reflected in the objectives that I just didn't highlight this afternoon. But this is where I think especially that staff will see that their voice has been heard, and that we are really looking to, for all, make this a better agency. And I think with this next 5-year plan will help us chart that course.
Do you have the objectives?
I do. And in
Maybe
fact,
you can just read it.
Sure, I'd be happy to.
us?
Yeah, I'd be happy to. So from maximizing voluntary compliance, our first objective is to improve our understanding of our taxpayers' needs and their expectations. So we'd like to use a lot of our data analytics in order to look at where are some of the gaps, maybe where are some of the educational opportunities we need to follow up on. We need to seek taxpayer feedback through multiple forums. So we need to continue to hear from our tax and fee payers, our stakeholders. We'd like to continually enhance our education and our outreach and the tools that help the taxpayers comply. As the chairman mentioned, the voluntary compliance rate, we'd only like to see it get better. Under our enhanced operational effectiveness, we have 3 objectives there. The first one is to achieve measurable standards of success for service, effectiveness, and efficiency. Benchmarking, how are we comparing? How can we do a good job, manage our performance in order to achieve those successes? Create a culture where we're looking to continually improve ourselves. The third objective under the goal 2 was to integrate state-of-the-art technology. As I'll give you in a subsequent report, that reflects our CROS project and the importance of that over the next 5 years to this agency. Because when we implement a CROS-type solution, that is going to be your generational solution for 10 to 20 years, likely. And then goal number 3, as you've clearly articulated, each of you, and we do with our staff, is invest in the organization, our most valuable asset, the employees. We need to prepare staff to succeed and lead. That's why my next presentation, we were going to talk I wanted to bring that forward to you to talk a little bit about that. And then looking at our functional alignment, how should we be aligned to provide the best services, the operational efficiencies? So to align the organizational structure around those core functions, and that was kind of Ms. Bridges' presentation in the past. So those are the objectives underneath our goals.
Just one addition to those.
Mm-hmm.
You put right in the front, in the beginning, continue to. We've been.
Yes.
Yeah, all right.
That's right.
All right. Further discussion, members? Hearing none, board will receive and file. Thank you very much for your presentation. Ms. Richmond?
Our next matter is item P13, Workforce and Succession Plan for 2015-2016, and there's another PowerPoint.
So joining me at the table at this time is going to be Ms. Adetola Didape, and she manages our workforce and planning section, and she's also my mentee. I'm her mentor in the board's mentoring program, and I thought, what a great opportunity to have her come and join me at the table and experience presenting to the board members.
We'll see how well you did.
I know. So anyway, it's my pleasure to turn the presentation over to Ms. Didape.
Thank you, David. Good afternoon, Chairman Horton and members of the board. In September of 2013, the Workforce Planning Section started working with departments and assisting them in identifying workforce and succession planning issues and trends. Each department was tasked with creating an action plan. We found that 35% of our employees were eligible to retire and 49% would be eligible to retire within the next 5 years. The Workforce and Succession Plan fiscal year 2015-2016 report focuses on phase 1 of the plan, which is to identify succession planning issues and implement strategies. The report includes information and data compiled from the action plans, and we will be implementing the next 3 phases, which is to conduct the workforce analysis, implement the workforce plan, and monitor, evaluate, and revise over the next 5 years. Each department's action plan contained 4 core strategies in order to address the specific needs of the department, which was focused recruitment and retention, formalized knowledge transfer procedures and methods, succession planning for mission-critical high-level leadership positions, and to continue to evaluate and monitor the effectiveness of the plan. That concludes my presentation. I'm happy to answer any questions. How'd I do?
Succession, I can't even, get it out for some reason. Are we, the Board of Equalization, planning to separate from the state by any chance?
Not that I know. Is that a trick question?
Yes.
Not that I know
I
of.
think he directed that to you.
Not that I know of.
Did you do a survey to determine why so many people are retiring? Did I have anything to do with that?
Probably.
Trained to
And
It's generation.
I have been here a long time. Okay. Your mentor.
Good guy.
Good guy. Okay. All right. This your first time before the board?
It is.
Oh, okay. Remember, Mark got a bunch of questions. See all these questions here? Remember, Mark.
Yeah, I do have a question. Beside the ages of the workforce profile, I know there's like sweet spots between how long people normally stay. Is it, 1 to 10 years, 10 to 20 years, 20 years and over? Did your group look at that as well as part of the succession planning? Because people who tend to be here like over 10 years maybe are going to stay until
That's a good question.
a certain amount of time, and I'm not sure whether we've determined kind of what those sweet spots are.
We looked at specifically the age and what's the general retirement age, which is usually the age of 60. We find that a lot of people retire based upon their age and when they're invested and when they can leave. We didn't take a look at the sweet spots. That's something that we can definitely take a look into. A lot of it was planned based off the numbers of the MERS report and what age people are usually leaving state service, which she found to be the age 60 is when they typically get out of here.
Yeah. And I think what I have seen over my career is, and we're seeing new generations come in that have different job expectations and are looking for different things and things quicker. We've got to be ready to take that on as well and to have satisfying careers for them that we hope we can retain them to have long careers here as well.
Yeah, and so I've noticed with some of our younger employees that they start in one position, then transfer to another position, and I've asked them, why do you keep moving around? And they basically said, or even moving offices.
Right.
Because of the opportunities. And I don't know whether there's a way we can look at opportunities in, specific offices, so they don't have to keep moving, from San Francisco to Oakland to San Jose to, Fresno, for example, whether that is also part of the succession planning.
I think a lot of that has to do with the time and generation that we're in. I think usually in the past you used to see a lot of people who would stay in their positions for a long time. Now we live in the microwave generation where they want it fast and they want it quick. And so we see a lot of people moving because that's the norm for them to stay in a position for a couple of years and then move on to the next. And so one of the things that we're looking at is how do we really have employees be interested in staying in a position and making sure that they have the skill sets required in order to move up. But we think a lot of that has to do with the time that we're in, because a lot of the baby boomer generation is going out and we have the new millennials coming in, and technology is fast, it's changing. And so a lot of those changes are based upon they don't want to stay in the positions for a long time. They want it fast and they want it easy. And so that's some of the things that we're looking at. One of the biggest things that we see, why we see a lot of people moving so quickly. It's not how it used to be. They want it fast and they want to move up and make money as soon as possible.
And I think another perception is that when you take a certain test, you're eligible for a promotion, and people are taking the test and kind of waiting in limbo. I think we either have to manage expectations, or if you're going to promise people that if they take the test, they're going to get promoted, we need to adhere to it, because there's also, a lot of frustrations out there that people have taken a test and they're just waiting and not hearing if they're going to get promoted. And so I don't know if you're looking at those type of, traditional, promotional opportunities, or whether it's written, or because, that's what I've heard, is that people have taken the test and normally they're supposed to get promoted, but they're not.
So I think that, you mentioned part of it is managing expectations. It's having those vacancies, it's having those positions then to move up into. So that is part of it. I think that we describe here, and I did in the previous one, we need to continue to look at how do we examine staff? What is the right way to provide that opportunity? But it's something that we should make as part of this plan and continue to look at. That's a very good point you raise.
Okay.
Member Harkey?
I don't want this answered today, but I would think that there'd be some position or some vacancies coming forward in the future that'd be more of a problem for the agency than others. And so I'd like to see the critical, so to speak, needs sometime are somehow broken out.
Yes, we will do that and get that to all the members.
Thank you.
Member Stowar?
On recruitment and retention, is BOE experiencing where their most experienced auditors, collectors, attorneys are leaving to go outside? And if so, have you done anything to try to get them back? Because sometimes we do come back. I know I did.
Yes, I think what I have seen over the years is the ebb and flow as the economy continues to improve and private expands. They like to recruit our people. As the economy contracts, sometimes our people are, the opportunities aren't always as there as possible. So I think it kind of ebbs and flows with the economy is one part of it. But I think that we do continue to need to look at the recruitment and retention. We also see it, and I know one of the things I've done this last year, which was very valuable, was to go around to all the district offices and to see the different geographic locations in the economies of each of the different district offices, the high-cost areas that we have in certain areas. And as Ms. Ma mentioned earlier, what I was very impressed with, because they're looking for their careers, is the willingness of people to move across, whether it's the Bay or in Southern California, to the different locations. They will travel great distances to look for that next opportunity. So as we progress, and as our auditors are in the field, our collectors are in the field sometimes, some of our desk jobs, what's the solution of CROS going to provide? What kind of opportunities is that going to give us that, maybe make things more mobile too?
Member Runner?
I guess on that same vein then too, I think that as we continue to see how we might implement CROS and also look at other kind of agency activities that have kind of been centralized, getting those out to the districts then provides then more opportunities for people for promotion out there. Because again, moving is a pain. And oftentimes people do that. I have people who are commuting in to one office. They left one office to get a promotion in another office, and it puts them on the road in order to be able to do that. So I think one of the issues that we continue to do, and I appreciate, is to look at what kind of activities can we actually then push down into the district offices, which then allow for more opportunities there and longer stays for people there, more opportunities for management there. And so I appreciate that as we continue to do that.
Certainly.
Yeah, these new employees are, not only are they willing to move, they're willing to move their entire family. Mm-hmm. I mean, I've had individuals on my team that said they just want to move to Sacramento. Why? They just want to move there. Opportunities are better. Whole family. Start a new family. So it's a different generation with a different culture and a different view, as you articulate. A couple of things, in addition to what the members have shared, is that and I know I may be a little bit redundant here, but I think it's important that we look at this whole concept of diminishing return. At what point do we meet our diminishing returns? And should we, in fact, be a larger, friendlier organization because the productivity and the opportunities are there, which gives us an opportunity to create promotional opportunities as well. Parity classification to ensure that there's classification between parities between our organization, the Internal Revenue, as well as the Franchise Tax Board, which happens to have a Tax Council 5 and happens to have an auditor 5, 6, 7, and 8. Maybe it's time that we take a look at that because I believe the workload is there in order to support that activity. And quite frankly, I think that's easier for the legislature to conceive. And success there actually trickles down. I don't particularly like that term, but trickles down to allow openings at the entry level for individuals to come in and start their careers with the Board of Equalization. Economic reality is that, as you said, David, is that we're going to have to compete with private. We can't compete with private industry, and there are a lot of reasons for that. They're hourly based, they're partnership based, they're fee based, and so forth, which determines their salaries, not necessarily not necessarily the number of hours you spend on the job. Possibly we can begin to codify these things in some sort of a document and then begin to articulate it to our staff so that oftentimes what keeps people on board is hope. And as long as they have hope that there's an opportunity, and we are in a very fortunate position that 35% of our staff is interested in retiring, that's creating an opportunity and also creating a brain drain on this organization, brain drain on the state of California. Which brings me to my last and final point is that let me continue to encourage the concept of transitioning, allowing employees to transition where your mentee becomes the mentor for someone else, and where all the executives here have individuals that are being prepared to matriculate into those leadership positions. We actually identify and begin to train those individuals and have that leadership, professional development, management, organizational skill. That type of training we need to provide more of so that we're positioning them to do so. The unfortunate thing, the better job we do, the more industry is excited about getting our
Very true.
They don't give them pensions. They don't give them pensions.
They don't give them pensions, Ms. Harkins said. Okay, thank you very much, Board. We'll receive and file. Ms. Richmond, what is our next matter? Well done. You did an exceptional job. And before you go.
You're talking Mr. Gao, or are you talking about the mentee?
I got a couple of questions before you go. Just kidding.
Mentee, she's the mentor.
We'll get there.
She's his mentee.
Spearman. Ms. Richmond.
Our next matter is P14, cross-project update and actions.
Good afternoon, members. The board is continuing to evaluate the final proposals for the CROS project. The next milestone will be a public cost opening, which we anticipate to occur in February of 2016. The project team continues to make progress on several of their pre-implementation activities. Just to highlight a couple, they recently submitted to the legislature their annual report, and they also automated the revenue stream reports, and those are what will be used to determine vendor compensation during the implementation, so a couple milestones there. We also had a kickoff of the CROS organizational change management activities that was conducted earlier this month. With respect to budget issues, the project has met with the Department of Finance and the Department of Technology to preview our spring finance letter and also our special project report, which will provide CROS funding for the 16-17 fiscal year as well as the 17-18. The objective of the meeting was really just to start getting some early feedback on some potential red flags or issues. The meeting went well, and the project continues to prepare these documents.
And then in October of 15, our expenditures for the month were about $666,000. That was under budget of $732,000. And then as far as year-to-date and project-to-date, the project does remain under budget in both year-to-date as well as project. That concludes my report. Thank you.
Discussion, members. Without objection, members will receive and file. Thank you very much, Mr. Gao.
Thank you, members.
Ms. Richmond.
That concludes our administrative session. Next are those items that have been taken under submission.
3-day review issue.
We took that off. I thought moved so that they could work on it.
I thought it got resolved, okay.
Okay. Good? Break?
Good,
What's that?
good.
Need a break? Good?
No, I'm good.
Go, we only got a
Good?
couple things.
Good?
Our
Okay.
first item is B1, Craigslist, Inc.
Is there a motion, members?
Move to sustain the franchise tax board.
Member Stowart moves to sustain the franchise tax board, second by Member Ma. Without objection, members, such will be the order. Ms. Richmond?
Our next item is B2, Hexu Zhao.
Move to sustain the FTB.
Member Harkey moves to sustain the FTB, second by Member Ma. Without objection, members, such will be the order.
Our next item is C1, ROX LLC.
I'm going to move to abate the fraud penalty and instead assert a 10% penalty for negligence.
So moved, second by Member Ma. Objection noted. Ms. Richmond, please call the roll.
Mr. Horton?
Aye.
Ms. Harkey?
Aye.
Mr. Runner?
Aye.
Ms. Ma?
Aye.
Ms. Stowers?
No.
Motion carries.
Ms. Richmond?
Our last item is C4, CBC Steel Buildings LLC.
Members?
This is a tough one. I'm going to move to grant the appeal.
I'll second.
Member Harkey moves to grant the appeal, second by Member Runner. Objection noted. Ms. Richmond?
Point of clarification, if we might, if that motion were to pass, the board should consider conditioning the refund on the return of the excess tax reimbursement to the contractor in accordance with Regulation 1700B, because that conclusion would be that tax was collected on a non-taxable portion transaction.
One more time.
So,
A motion in favor of the taxpayer is to grant a refund to the taxpayer, but they've collected excess tax reimbursement if that motion were to prevail. So it should be conditioned on returning it to the customer from whom they collected it, which is the contractor. And that's in accordance with Regulation 1700B, too.
yeah, I kind of thought that was automatic, but Mr. Runner, objection to that?
No.
No objection to that being the case. Second, maker of the motion has accepted that. Presuming the second has as well. Such will be the motion. Any discussion in that regard? So in essence,
To grant, excuse me,
to grant would provide $42,000, $45,000, $46,000.
although the claimant was not,
But the payment was made. It was just convoluted, if you recall. It was a contractual, let's say,
yeah, I mean, I understand.
it was substance, or, form over substance, in my opinion, and that's why I made the motion. I think the taxes were paid, or the taxes were paid. The refund was intended to be for the purpose of, but only it was to a different entity, which confused, and the taxpayer has done it properly going forward, so.
Yeah. My concern with this is that we're establishing that even if the taxpayer actually has done it wrong going forward and should make the adjustments subsequent to this, if this is the ruling of the body, all the other transactions are wrong. This one's right, but every other one that he's done right, according to what the department has said, is actually wrong.
Well, we're not writing an opinion on this. I mean, it's not like we're going to use this time and time again. I think this was an extenuating circumstance. It was really confusing, I think, for everybody involved. And
Okay. My other concern with this, members, is that it's just, I mean, unfortunately, the legislature does form over substance all the time, and then we're stuck here having to follow the law. Or attempt to. And part of the reason that they, at least when I served there, is there's a revenue issue if they if they expanded it to manufacturers, it would expand the revenue based on the revenue adjustment. The other issue is when they expand it to the manufacturers to be able to, in fact, actually take the credit or make this transaction, which is in what is taking the case, they're able to collect sales tax from a vendor, pay it to the Board of Equalization, offset it on their tax returns. And so the intent is to sort of isolate the tax credit or the tax benefit to the individual, in this case the farmer, and not to expand that credit beyond the dollars allowed by the legislature. I certainly would support legislation to amend that. Quite frankly, I think the dollar value might not make it.
This is not what, I don't think this is what this is. This is clearly the issue that, again, I get the hurdle, I get the problem. I know why it's a hassle to do it. I get the fact that the law is specific on this issue. I just get frustrated when it is that somebody who is supposed to, with the intent of the law, be able to get to receive the tax benefit. And because of the procedural issues, this is the procedural issue. This isn't trying to give it to the manufacturer. This is a procedural issue that kept it out of the hands of the intended person, which was the farmer. So I get the hassles. I know why this is a hurdle. But at the end of the day, I just have a hard time when a farmer comes up here and says, why don't I get this? I did everything. I'm a farmer. This is what the intent of the legislature was. Why don't I get this? We say, well, if you would have just bought the building and this guy would have just built it for you, then you would have been okay. I get why citizens get frustrated with the system. And so when it comes to me, I'm just willing to go ahead at times and say, look, I think we need to understand that sometimes the system's too nuanced for people. I think this is a perfect example of why we have to have aggressive education systems out there. Why doesn't we need to be out in the field? Why we need people out in the field talking about these kinds of things so that people don't miss the opportunity that is there when they get. My concern always has been, I believe people need to pay the proper amount of tax. That means they should get all the tax benefit too. This is a guy who didn't get the tax benefit he should have.
Well, I share the frustration, and I think everybody shares the frustration. We get it. And this farmer that's come before us recorded it wrong. I don't know why. I do know the tax benefit to the manufacturer has incurred, and don't think that that's going to be unwind by our vote. And so we're going to end up with two parties out there benefiting from this. And not only this farmer, but then the concerns goes to every other farmer who did it right. Every other farmer who had the benefit of a zero-sum gain environment where there's a limited amount of tax credits that are provided by the legislature. Now the incumbency upon them, and it creates a problem. And so, anyway, that's my concerns. There's a motion on the floor. There's a second. Objection noted. Member Mo.
I'm sorry. I didn't understand. Or I just missed the conversation about the farmer contacting the BOE and the BOE giving them the advice or not accepting their amendment. I
could probably, but I would prefer to go to appeals.
My understanding of the testimony was that the parties tried to get CBC to rewrite that contract or somehow revise it. There's a problem, as David Levine would say, once you've rung that bell, the sale occurred, and apparently the vendor would not revise the contract. And so the transaction actually was a sale to this contractor rather than to the farmer. BOE would have no ability to rewrite someone else's contract after the fact.
And the other challenge, Member Ma, was it was 2 years subsequent to the actual transaction, and the manufacturer himself refused to do it.
Yeah, the manufacturer would.
And it makes sense why that would be the case.
I wouldn't do it either. He's got the tax benefit.
Does he have the tax benefit?
He didn't have the tax benefit.
He doesn't have the tax benefit. He actually sold the item.
He sold the item.
He didn't get the tax
He had income
credit.
that was offset by tax liability, even though appropriately so. And if we unwind everything and made an amendment to his tax returns, amendment to the growers' tax returns, who reported and paid a sales tax that he could have probably deducted because he paid it and deducted it out of his expense, expensed it off his income statement, and if he goes in and we give it back to him, theoretically, I guess it would get recognized as some form
Give
of
it back to him.
income in his subsequent filing, or maybe the statute of limitations has passed and he won't have to even recognize the 35 that gets, anyway, it's just, I mean, I think that's why the law is the law, you know, and that's why the law isn't expanded to the manufacturers, and they have these conditions in place because of these double-edged swords and all of these consequences. The intent is to direct exemption to the farmers that are out there and to assure that all the farmers that are out there have the benefit of this deduction. And when you have manufacturers being able to take the deduction because of their association, you take away a benefit from all the other farmers out there.
No, that's not what took place, but that's fine.
I know, Member Runner, we got two different views on it. Yeah. Okay, there's a motion and a second. Further discussion, members? Here none. Noting objection, Ms. Richmond, would you please call the order?
Mr. Horton?
No.
Ms. Harkey?
Aye.
Mr. Runner?
Aye.
Ms. Ma?
No.
Ms. Towers?
No.
Motion
Well,
failed.
we tried.
Well done, Member Harkey, Member Wong.
Tried. Okay.
Ms. Richmond,
The motion failed.
subsequent motion, members.
Move to support the department.
Member Harkey moves to sustain franchise tax board, second by Member Ma. Without objection, members.
DOE is the department, not FTB.
BOE, support the BOE.
BOE. Move to support.
I didn't say department. Member,
Sales.
strike that. Member Harkey moves to sustain the department, second by Member Ma. Without objection, members, such will be the order. Ms. Richmond.
That concludes our business for today.
Members, I would ask that we adjourn our meeting in memory of the individuals who have lost their lives in San Bernardino, and our condolence goes out to those families. It's a very tragic situation, but we certainly want to acknowledge that all of California, all of America stands with those families. And to the extent that we can be of any assistance, let's ensure that we reach out and make that happen. The meeting of the Board of Equalization. Oh, before I close as well, let me thank Mr. Bowden and the district administrator and the various offices, and particularly the Norwalk office. They did an exceptional job. Their courage in the face of adversity, their commitment to their employees to make sure that all their employees are safe and so forth. They engage with every investigation office out there and just did a fabulous job. To the extent that we can acknowledge someone for their valor and give them an award, we certainly need to provide that to those individuals, including the Riverside office in Mr. Runner's district. With that, the meeting of the Board of Equalization is hereby
Close to
adjourned.
my district.
Close to my district.
Riverside.
Oh, yeah, close. Member Harkey.
Those are my folks.